Hi, good day. Today I will take you on a tour on what real estate acquisition is and some concepts associated with it. It's going to be really expository, so I implore you to sit back while we unravel the subject. I really do hope that at the end of the course, you get enlightened about real estate acquisition and that you take the right steps towards progress. Introduction to estate acquisition. Real estate acquisition is the process of purchasing property or real estate with the intention of holding it for a long-term investment or for immediate resale. Real estate acquisition can be an attractive investment option for individuals, corporations, or other entities looking to build wealth through property ownership, rental income, or capital appreciation. Real estate acquisition involves various steps, including identifying the type of property, conducting a market analysis, and performing due diligence on the potential acquisition. Due diligence is the process of verifying the accuracy and completeness of all information related to the property, including financial statements, leases, zoning regulations, and environmental assessments. Once due diligence is completed, the next step is to determine the value of the property. This involves analyzing comparable sales, rental rates, and other relevant factors to arrive at an estimated value of the property. Financing is another critical aspect of real estate acquisition. Funding options may include traditional bank financing, seller financing, or private lending. In some cases, investors may partner with others to acquire the property, or they may form a real estate investment trust, REIT, or syndicate. There are several types of real estate acquisitions, including residential, commercial, industrial, and land. Residential properties include single-family homes, condominiums, townhouses, and multifamily buildings. Commercial properties include office buildings, retail centers, hotels, and warehouses. Industrial properties include factories, manufacturing facilities, and distribution centers. Land acquisitions involve the purchase of undeveloped or raw land that can be used for future development. Real estate acquisition offers several benefits, including the potential for long-term appreciation, cash flow from rental income, and tax benefits. However, there are also risks involved, such as fluctuations in the real estate market, unforeseen expenses, and changes in local zoning or environmental regulations. In summary, real estate acquisition is the process of purchasing property for investment purposes. It involves identifying the type of property, performing due diligence, determining the property value, and securing financing. Real estate acquisition offers many benefits, but investors must also be aware of the risks and challenges involved in this type of investment. Types of real estate. Real estate refers to land and any permanent improvements made to it, such as buildings, homes, or other structures. There are several types of real estate, each with unique characteristics and investment opportunities. The main types of real estate include residential, commercial, industrial, and land. 1. Residential real estate. Residential real estate includes properties designed for individuals or families to live in, such as single-family homes, apartments, townhouses, and condominiums. Residential properties are usually purchased for personal use, but they can also be purchased as investment properties for rental income or resale. Residential real estate is often valued based on the location, size, condition, and amenities of the property. 2. Commercial real estate. Commercial real estate refers to properties used for business purposes, such as office buildings, retail centers, hotels, and restaurants. Commercial properties are usually leased to tenants for income generation. Commercial real estate is valued based on the income generated by the property, location, condition, and tenant mix. 3. Industrial real estate. Industrial real estate includes properties used for manufacturing, warehousing, and distribution, such as factories, warehouses, and logistics centers. Industrial properties are often located in areas with easy access to transportation and distribution channels. Industrial real estate is valued based on the size, condition, location, and functionality of the property. 4. Land. Land refers to undeveloped or raw land that has not been improved or developed. Land can be used for future development, such as building residential or commercial properties, or it can be used for agricultural purposes. Land is valued based on its location, size, zoning, topography, and potential for development. In addition to these primary types of real estate, there are also specialty real estate categories, such as healthcare facilities, senior living facilities, and student housing. These properties have specific requirements and regulations that must be considered when investing in them. Real estate investing offers a wide range of opportunities for investors to build wealth and generate income. Each type of real estate has its own unique characteristics, risks, and benefits. By understanding the different types of real estate and their investment potential, investors can make informed decisions that align with their investment goals and risk tolerance. Advantages of venturing into real estate acquisition. Real estate acquisition is a popular investment strategy for individuals and businesses looking to build wealth, generate passive income, and diversify the portfolio. There are several advantages to investing in real estate acquisition, including 1. Potential for long-term appreciation. Real estate has historically appreciated over time, meaning its value increases over the long term. This appreciation can provide investors with a valuable asset that increases in value over time. 2. Cash flow. Rental income generated from real estate investments can provide investors with a steady stream of cash flow. This income can help cover the costs associated with owning the property, such as mortgage payments, property taxes, and maintenance expenses. 3. Tax benefits. Real estate investors may be eligible for several tax benefits, including deductions for mortgage interest, property taxes, and depreciation. These tax benefits can help lower the overall tax burden on the investment property and increase its profitability. 4. Diversification. Real estate investment can provide investors with a diversified portfolio, helping to spread risk across different asset classes. Diversification can help reduce overall portfolio risk and provide a hedge against inflation. 5. Control. Real estate investors have a high degree of control over their investment, including the ability to make improvements, set rental rates, and choose tenants. This level of control can provide investors with a greater degree of certainty over their investment returns. 6. Hedge against inflation. Real estate investments can serve as a hedge against inflation since rental income and property values tend to increase in line with inflation. 7. Leverage. Real estate investors can use leverage to increase the purchasing power and generate higher returns on their investment. Financing options, such as mortgages and seller financing, can help investors acquire larger properties and generate higher returns. 8. Legacy building. Real estate acquisition can provide investors with an opportunity to build a legacy for future generations by owning a valuable asset that can be passed down through the generations. In summary, real estate acquisition offers several advantages, including the potential for long-term appreciation, cash flow from rental income, tax benefits, diversification, control, a hedge against inflation, leverage, and legacy building. These benefits make real estate a compelling investment option for individuals and businesses looking to build wealth and generate passive income over the long term. Disadvantages of venturing into real estate acquisition. While real estate acquisition offers several advantages, it also comes with several potential disadvantages that investors should consider. Some of the main disadvantages of real estate acquisition include 1. Illiquidity. Real estate investments can be illiquid, meaning they cannot be easily converted into cash. This lack of liquidity can make it difficult for investors to sell the property quickly if they need to access funds. 2. High transaction costs. Real estate transactions can be costly, including expenses such as closing costs, legal fees, and real estate agent commissions. These costs can significantly reduce the profitability of the investment, especially for smaller transactions. 3. Property management. Owning a rental property requires significant time and effort to manage, including finding tenants, collecting rent, and handling maintenance and repairs. Property management can be time-consuming and require additional expenses, such as hiring a property manager. 4. Market volatility. Real estate values can be subject to market volatility, just like any other investment. Economic downturns, changes in interest rates, or a decline in property values can negatively impact the investment's profitability. 5. Risk of default. Real estate investments are often financed with mortgages, and there is a risk of default if the borrower is unable to make their mortgage payments. This can result in foreclosure and the loss of the property. 6. Environmental and legal issues. Real estate investments can be subject to environmental and legal issues, such as zoning laws, building code violations, or environmental hazards. These issues can be costly to resolve and can significantly impact the property's value. 7. Tenant risk. Rental income is a significant component of real estate returns, and there is a risk that tenants may default on their rent payments or cause damage to the property. This risk can be mitigated through careful tenant screening and property management. In summary, real estate acquisition comes with several potential disadvantages, including illiquidity, high transaction costs, property management requirements, market volatility, default risk, environmental and legal issues, and tenant risk. It's essential for investors to carefully consider these factors when evaluating real estate investment opportunities and to develop a solid investment strategy that mitigates these risks. The contemporary real estate market trend. The contemporary real estate market is constantly evolving, with new trends emerging in response to changes in the economy, demographics, and technology. Some of the current trends in the real estate market include: 1. Focus on sustainability. There is an increasing focus on sustainability in real estate development and construction. This includes using environmentally friendly building materials, incorporating green technologies such as solar panels and energy-efficient HVAC systems, and designing buildings to be more energy efficient. 2. Digitalization and automation. The use of technology in real estate is increasing rapidly, with new tools and platforms emerging to automate and streamline various aspects of the industry. This includes virtual property tours, online property management software, and AI-powered analytics tools for real estate investment and decision-making. 3. Shift to suburbs and secondary markets. The COVID-19 pandemic has led to a shift away from urban centers, with many people opting to move to suburbs or secondary markets to escape the high density and costs of urban living. This trend is expected to continue even after the pandemic, as remote work and flexible work arrangements become more common. 4. Rise of co-living and co-working spaces. Co-living and co-working spaces are becoming more popular, especially among younger generations who prioritize socialization and community. These spaces offer shared living and workspaces, allowing individuals to live and work in close proximity to others with similar interests and lifestyles. 5. Demand for affordable housing. The affordability crisis is one of the most significant challenges facing the contemporary real estate market, with many people struggling to find affordable housing in urban areas. This has led to a growing demand for affordable housing solutions, including micro-apartments, co-housing, and modular construction. 6. Growth in multifamily and mixed-use developments. Multifamily and mixed-use developments are becoming more popular, especially in urban areas where space is limited. These developments offer a mix of residential, commercial, and retail spaces, creating a more diverse and dynamic living environment. 7. Expansion of short-term rentals. Short-term rentals, such as Airbnb, are becoming increasingly popular as travelers seek more flexible and affordable accommodation options. However, this trend has raised concerns about the impact on local communities and housing availability, leading to increased regulation and scrutiny. In summary, the contemporary real estate market is characterized by a focus on sustainability, digitalization, and automation, a shift to suburbs and secondary markets, the rise of co-living and co-working spaces, a demand for affordable housing, growth in multifamily and mixed-use developments, and the expansion of short-term rentals. These trends are likely to continue shaping the real estate market for the foreseeable future, and investors and industry professionals must stay informed and adaptable to remain successful. Factors affecting real estate acquisition. Real estate acquisition involves the process of purchasing and owning property for investment or personal use. Several factors can impact real estate acquisition decisions, including 1. Location. The location of a property is one of the most critical factors affecting real estate acquisition. Factors such as proximity to schools, shopping centers, hospitals, and public transportation can significantly impact property values and rental income potential. 2. Market conditions. Real estate acquisition decisions are also influenced by market conditions such as supply and demand, interest rates, and economic conditions. Investors must carefully analyze the market to identify trends and potential opportunities. 3. Property condition. The condition of a property is also an essential factor affecting real estate acquisition decisions. Properties that require significant repairs and renovations may be less attractive to investors unless they offer significant upside potential. 4. Financing options. Real estate acquisition decisions are also affected by financing options such as mortgage rates, loan terms, and down payment requirements. Investors must consider their financial situation and the available financing options to make an informed decision. 5. Legal and regulatory issues. Legal and regulatory issues such as zoning laws, building codes, and environmental regulations can significantly impact real estate acquisition decisions. Investors must carefully research and understand these issues to avoid potential legal and financial liabilities. 6. Investment goals. Real estate acquisition decisions are also influenced by investment goals such as short-term versus long-term investment horizons, cash flow requirements, and risk tolerance. Investors must consider their investment objectives and align them with the potential benefits and risks of the property. 7. Property type. The type of property, such as residential, commercial, industrial, or mixed use, can also impact real estate acquisition decisions. Different property types have unique characteristics, risks, and potential returns, and investors must carefully consider these factors before making a decision. 8. Competition. Competition from other investors and buyers can also affect real estate acquisition decisions. In a competitive market, investors may need to act quickly and offer competitive terms to secure a desirable property. In summary, several factors can impact real estate acquisition decisions, including location, market conditions, property condition, financing options, legal and regulatory issues, investment goals, property type, and competition. Investors must carefully consider these factors and conduct thorough due diligence to make an informed decision and achieve their investment objectives. Legal issues in real estate acquisition. Legal issues are a crucial aspect of real estate acquisition. The acquisition process involves various legal documents, including purchase agreements, deeds, and financing documents. The following are some of the legal issues that can arise during the real estate acquisition process. 1. Title issues. Title issues are a common legal issue in real estate acquisition. A title search is conducted to determine the property's ownership history and ensure that the seller has clear title to the property. If title issues arise, such as liens or encumbrances, they must be addressed before the acquisition can proceed. 2. Zoning and land use regulations. Zoning and land use regulations can significantly impact real estate acquisition. Investors must understand and comply with local zoning laws and regulations, which can impact property use and development potential. 3. Environmental regulations. Environmental regulations can also impact real estate acquisition. Environmental assessments may be required to identify potential contamination or other environmental issues that could affect the property's value or use. 4. Contractual issues. Contractual issues can arise during the real estate acquisition process. Purchase agreements, financing documents, and other legal documents must be carefully drafted and reviewed to ensure that they reflect the parties' intentions and protect their interests. 5. Financing issues. Financing issues can also impact real estate acquisition. Financing documents must be carefully reviewed to ensure that they reflect the parties' intentions and protect their interests. Investors must also comply with lending requirements and regulations to secure financing for the acquisition. 6. Tax issues. Tax issues can arise during real estate acquisition. Investors must carefully consider the tax implications of the acquisition, including property taxes, income taxes, and capital gains taxes. 7. Disputes and litigation. Disputes and litigation can arise during the real estate acquisition process. Investors must be prepared to resolve disputes through negotiation, mediation, or litigation, depending on the nature of the dispute. In summary, legal issues are an essential aspect of real estate acquisition. Investors must carefully consider and address legal issues during the acquisition process to avoid potential legal and financial liabilities. Consulting with legal professionals experienced in real estate law is critical to ensure a successful and legally sound acquisition process. Financing options for real estate acquisition. Financing is a critical aspect of real estate acquisition. Investors typically require financing to purchase a property, and several financing options are available. The following are some of the most common financing options for real estate acquisition. 1. Conventional mortgages. Conventional mortgages are one of the most common financing options for real estate acquisition. Conventional mortgages are offered by banks and other lending institutions and require a down payment, typically between 5% and 20%, depending on the lender's requirements. The loan term can range from 15 to 30 years, and interest rates are based on the borrower's credit score, income, and other factors. 2. Government-backed mortgages. Government-backed mortgages, such as those offered by the Federal Housing Administration, FHA, and the Department of Veterans Affairs, VA, are another financing option for real estate acquisition. These loans typically require a lower down payment than conventional mortgages, and the borrower must meet certain eligibility requirements. 3. Hard money loans. Hard money loans are another financing option for real estate acquisition. These loans are typically offered by private lenders and require a higher down payment, typically between 20% and 50%. The loan term is shorter than conventional mortgages, typically between 1 and 5 years, and interest rates are higher. 4. Seller financing. Seller financing is another financing option for real estate acquisition. In this arrangement, the seller provides financing to the buyer, typically in the form of a loan. The terms of the loan are negotiated between the buyer and seller, and the buyer makes payments directly to the seller. 5. Private equity. Private equity is another financing option for real estate acquisition. Private equity investors provide funding to investors in exchange for an ownership stake in the property. Private equity investors typically require a higher return on their investment than traditional lenders, and the terms of the investment are negotiated between the parties. 6. Crowdfunding. Crowdfunding is a relatively new financing option for real estate acquisition. Crowdfunding platforms allow investors to pool the funds to invest in real estate projects. Investors typically receive a return on their investment based on the project's performance. In summary, several financing options are available for real estate acquisition, including conventional mortgages, government-backed mortgages, hard money loans, seller financing, private equity, and crowdfunding. Investors must carefully consider their financial situation, investment objectives, and the terms of each financing option to make an informed decision. Consulting with a financial professional experienced in real estate finance is critical to ensure a successful financing strategy. Risks and rewards of real estate investment. Real estate investment offers both risks and rewards to investors. Understanding these risks and rewards is critical to making informed investment decisions. The following are some of the risks and rewards of real estate investment. Risks. 1. Market risk. Real estate investment is subject to market risk, which is the risk that the value of the property will decrease due to market conditions, such as a decline in demand or oversupply. 2. Economic risk. Economic risk is the risk that the value of the property will decrease due to economic conditions, such as a recession or job loss. 3. Liquidity risk. Real estate investment is less liquid than other investment options, such as stocks and bonds. This means that it may be more difficult to sell the property quickly if needed. 4. Property-specific risk. Real estate investment is subject to property-specific risks, such as natural disasters, tenant turnover, and property damage. Rewards. 1. Appreciation. Real estate investment offers the potential for appreciation, which is an increase in the property's value over time. This can result in significant capital gains for investors. 2. Cash flow. Real estate investment can provide steady cash flow in the form of rental income. This can provide a reliable source of income for investors. 3. Tax benefits. Real estate investment offers several tax benefits, including depreciation, interest deductions, and property tax deductions. These benefits can reduce the investor's tax liability and increase cash flow. 4. Inflation hedge. Real estate investment can serve as an inflation hedge, as the property's value and rental income can increase over time to keep pace with inflation. 5. Diversification. Real estate investment can provide diversification benefits to an investor's portfolio. Real estate investment is less correlated with other asset classes, such as stocks and bonds, which can reduce overall portfolio risk. In summary, real estate investment offers both risks and rewards to investors. Understanding these risks and rewards is critical to making informed investment decisions. Consulting with a financial professional experienced in real estate investment is recommended to ensure a successful investment strategy. The real estate acquisition process. The real estate acquisition process can be complex and involves several steps. The following is an overview of the real estate acquisition process. 1. Identify investment objectives. The first step in the real estate acquisition process is to identify investment objectives. This includes determining the investment strategy, such as whether the property will be held for rental income or sold for capital gains. 2. Research the market. The next step is to research the market to identify potential properties that fit the investment objectives. This includes analyzing the local real estate market, identifying trends and patterns, and assessing the supply and demand for the property type. 3. Property evaluation. Once potential properties have been identified, a thorough evaluation of the property is conducted. This includes assessing the property's condition, location, zoning, and potential for rental income or resale. 4. Financing. If financing is required, the next step is to secure financing for the property. This may involve obtaining a mortgage, working with private lenders or investors, or using other financing options. 5. Due diligence. Due diligence is the process of conducting a thorough investigation of the property before closing the deal. This includes reviewing legal and financial documents, obtaining inspections, and conducting property surveys. 6. Purchase agreement. Once due diligence has been completed, a purchase agreement is drafted and signed by the buyer and seller. This agreement outlines the terms and conditions of the sale, including the purchase price, closing date, and contingencies. 7. Closing. The final step in the real estate acquisition process is closing the deal. This includes transferring ownership of the property, paying closing costs, and recording the sale with the appropriate government agency. In summary, the real estate acquisition process involves identifying investment objectives, researching the market, evaluating potential properties, securing financing, conducting due diligence, drafting a purchase agreement, and closing the deal. Each step is critical to ensuring a successful real estate acquisition. Working with a qualified real estate professional can help ensure a smooth and successful acquisition process. The due diligence involved in real estate acquisition. Due diligence is a critical part of the real estate acquisition process. It involves a thorough investigation of the property to ensure that the buyer is making an informed decision and is aware of any potential issues or risks associated with the property. The following are some of the key areas that are typically included in a due diligence investigation. 1. Legal documents. A review of legal documents is an important part of the due diligence process. This includes reviewing title documents, deeds, easements, and any other legal agreements associated with the property. This helps to ensure that the property is free and clear of any liens or encumbrances that could affect the buyer's ownership rights. 2. Financial records. Financial records, such as tax assessments, property tax bills, and utility bills, are reviewed to ensure that the property has no outstanding debts or unpaid bills. This also includes reviewing the rent roll and lease agreements to ensure that the property is generating the expected rental income. 3. Physical inspection. A physical inspection of the property is conducted to identify any issues or repairs that may be required. This includes inspecting the building structure, electrical and plumbing systems, and the overall condition of the property. 4. Environmental assessment. An environmental assessment is conducted to identify any potential environmental risks associated with the property. This includes identifying any hazardous materials or contaminants that may be present on the property. 5. Zoning and land use. A review of zoning and land use regulations is conducted to ensure that the property is in compliance with local laws and regulations. This includes identifying any zoning restrictions or land use limitations that may affect the buyer's intended use of the property. 6. Market analysis. A market analysis is conducted to identify current and future market trends and potential competition. This helps to determine the property's potential for rental income or resale. 7. Property management. A review of property management practices and procedures is conducted to ensure that the property is being managed efficiently and effectively. This includes reviewing maintenance records, tenant complaints, and any legal disputes associated with the property. In summary, due diligence is a critical part of the real estate acquisition process. It involves a comprehensive investigation of the property to ensure that the buyer is making an informed decision and is aware of any potential issues or risks associated with the property. Working with a qualified real estate professional can help ensure a successful due diligence investigation. Real estate appraisal and valuation. Real estate appraisal and valuation is the process of determining the value of a property for a specific purpose, such as for financing, taxation, or investment purposes. Real estate appraisal and valuation is a complex process that involves a variety of factors, including market conditions, physical characteristics of the property, and economic trends. The following is an overview of the real estate appraisal and valuation process. 1. Identify the purpose. The first step in the real estate appraisal and valuation process is to identify the purpose of the appraisal. This includes determining the intended use of the property, such as for financing or taxation purposes. 2. Market analysis. The next step is to conduct a market analysis to identify the current market trends and conditions. This includes analyzing data on comparable properties in the area, identifying trends in property values, and assessing supply and demand for the property type. 3. Physical characteristics. The physical characteristics of the property are then assessed, including the size, condition, and age of the property. This includes conducting a thorough inspection of the property and identifying any defects or issues that may affect the value. 4. Income potential. If the property is being appraised for rental income, the income potential of the property is assessed. This includes reviewing current leases, analyzing market rents, and projecting future income potential. 5. Value determination. Using the information gathered in the market analysis, physical assessment, and income potential assessment, the appraiser determines the value of the property. This includes applying various valuation methods, such as the sales comparison approach, the income approach, and the cost approach. Report preparation. Once the value has been determined, the appraiser prepares a detailed report outlining the value of the property and the methods used to arrive at the value. This report is then used by the client for the intended purpose, such as for financing or taxation purposes. In summary, real estate appraisal and valuation is a complex process that involves analyzing market conditions, assessing the physical characteristics of the property, and determining the income potential of the property. The value of the property is then determined using various valuation methods, and a detailed report is prepared outlining the value of the property and the methods used to arrive at the value. Working with a qualified appraiser can help ensure an accurate and reliable appraisal and valuation of the property. Real estate market analysis. Real estate market analysis is the process of gathering and analyzing data to determine the current and future trends in the real estate market. It involves analyzing various factors that affect the demand and supply of properties, such as economic conditions, demographic trends, and government policies. The following is an overview of the real estate market analysis process. 1. Gathering data. The first step in real estate market analysis is to gather data on the local real estate market. This includes data on the number of properties for sale or rent, the prices of those properties, and the number of transactions that occur in the market. 2. Analyzing economic conditions. Economic conditions can have a significant impact on the real estate market. Analyzing economic indicators such as gross domestic product, inflation rates, and employment rates can provide insight into the health of the local economy and the potential demand for real estate. 3. Demographic analysis. Demographic trends can also impact the real estate market. Factors such as population growth, age distribution, and household income can affect the demand for properties in the market. 4. Government policies. Government policies, such as tax laws and zoning regulations, can impact the real estate market. Analyzing these policies can provide insight into how they may affect the supply and demand for properties in the market. 5. Identifying trends. After gathering and analyzing data on the local real estate market, the next step is to identify trends. This includes identifying trends in property prices, the number of transactions, and the demand for specific types of properties. 6. Forecasting. Based on the data and trends identified in the analysis, market analysts can forecast the future direction of the real estate market. This includes predicting the demand for properties, the supply of properties, and the potential impact of economic and demographic trends. 7. Reporting. Finally, the results of the analysis are compiled into a report that can be used by real estate professionals, investors, and other stakeholders. The report provides insights into the local real estate market, including trends, potential risks, and opportunities for investment. In summary, real estate market analysis is a critical process for understanding the current and future trends in the real estate market. It involves gathering and analyzing data on economic conditions, demographic trends, and government policies, identifying trends, forecasting future directions, and reporting the results. Accurate market analysis can help real estate professionals, investors, and other stakeholders make informed decisions about buying, selling, or investing in properties. Feasibility study in real estate acquisition. A feasibility study is a critical process in real estate acquisition that assesses the potential profitability and success of a real estate investment project. It is a comprehensive analysis of various factors related to the proposed investment, including market demand, location, competition, financial projections, and legal considerations. The following is an overview of the feasibility study process in real estate acquisition. 1. Market analysis. The first step in a feasibility study is to analyze the market demand for the proposed project. This includes gathering data on the local real estate market, such as supply and demand, rental rates, vacancy rates, and property values. Market analysis helps to determine the potential demand for the proposed property and its competitive advantage over existing properties in the market. 2. Location analysis. Location is a critical factor in real estate acquisition. A location analysis involves assessing the suitability of the proposed site for the intended purpose, including proximity to transportation, amenities, and the target market. The analysis also considers zoning regulations, environmental impact, and accessibility. 3. Financial projections. Financial projections are an essential part of a feasibility study, as they determine the potential profitability of the investment. The projections include estimates of construction costs, operating expenses, revenues, and profits. The analysis also includes a sensitivity analysis to determine the potential impact of changes in key assumptions, such as interest rates, rental rates, and occupancy rates. 4. Legal considerations. Legal considerations in real estate acquisition involve assessing the legal and regulatory framework that governs the proposed project. This includes zoning regulations, building codes, environmental regulations, and other legal requirements. The analysis also includes a review of contracts and agreements related to the project, such as construction contracts, leasing agreements, and financing agreements. 5. Risk assessment. A feasibility study also includes a risk assessment, which identifies potential risks and uncertainties that could impact the success of the project. This includes risks related to market demand, competition, location, financing, construction, and legal and regulatory issues. The risk assessment helps to determine the potential impact of these risks on the project and the strategies to mitigate them. 6. Report. The results of the feasibility study are compiled into a report that provides an overview of the proposed project, the market analysis, financial projections, legal considerations, risk assessment, and recommendations. The report is used by investors, lenders, and other stakeholders to determine the potential viability of the project and make informed decisions about investing in the property. In summary, a feasibility study is a critical process in real estate acquisition that assesses the potential profitability and success of a real estate investment project. It involves analyzing various factors related to the proposed investment, including market demand, location, competition, financial projections, and legal considerations. The results of the feasibility study are used to make informed decisions about investing in the property and to mitigate potential risks and uncertainties. Real estate investment strategies. Real estate investment is a popular and profitable way to grow wealth, and there are various real estate investment strategies that investors can use to maximize their returns. Below are some of the most common real estate investment strategies. 1. Buy and hold. This strategy involves purchasing a property and holding onto it for an extended period, typically several years or more. The goal is to generate income from rental payments and appreciation in the property's value over time. This strategy is ideal for investors who are looking for long-term, passive income streams. 2. Flipping. Flipping involves purchasing a property with the intention of quickly reselling it for a profit. This strategy requires a keen eye for identifying undervalued properties that can be renovated and sold for a higher price. This strategy can be risky, as it requires a significant investment of time and money into the renovation process and relies heavily on the current real estate market. 3. Value add. This strategy involves purchasing a property that is undervalued or underutilized and making improvements to increase its value. This can include renovating the property, increasing occupancy rates, or changing the property's use to generate more income. This strategy requires a thorough understanding of the local real estate market and the ability to identify opportunities for improvement. 4. REITs. Real estate investment trusts, REITs, are publicly traded companies that invest in a portfolio of real estate assets. Investors can buy shares of REITs, which provide exposure to real estate without the need to purchase and manage individual properties. This strategy is ideal for investors who want exposure to real estate but prefer a more passive investment approach. 5. Syndication. Syndication involves pooling money from multiple investors to purchase a larger real estate asset. This strategy is ideal for investors who want to invest in larger, more expensive properties but do not have the necessary capital to do so on their own. Syndication requires a strong network of investors and a thorough understanding of the legal and regulatory requirements. 6. Lease options. Lease options involve renting a property with an option to purchase it at a later date. This strategy can be beneficial for both the buyer and the seller, as it allows the buyer to lock in a purchase price while giving the seller a steady rental income. This strategy requires a thorough understanding of the local real estate market and the ability to negotiate favorable lease terms. In summary, there are various real estate investment strategies that investors can use to maximize their returns. These include buy and hold, flipping, value add, REITs, syndication, and lease options. Each strategy has its own unique advantages and risks, and investors should carefully consider their investment goals, risk tolerance, and market conditions before choosing a strategy. Real estate investment trusts, REITs. Real estate investment trusts, REITs, are investment vehicles that invest in a portfolio of income-generating real estate assets. These assets may include commercial office buildings, shopping centers, apartment complexes, hotels, and warehouses, among others. REITs provide investors with a way to invest in real estate without having to purchase and manage individual properties. REITs are required by law to distribute at least 90% of the taxable income to shareholders in the form of dividends. This makes REITs an attractive investment option for income-seeking investors, as they provide a steady stream of income. Additionally, REITs are often more liquid than physical real estate investments, as they can be bought and sold on public exchanges. There are two main types of REITs, equity REITs and mortgage REITs. Equity REITs invest in physical properties and generate income through rental payments and capital appreciation. Mortgage REITs, on the other hand, invest in mortgages and other real estate debt instruments and generate income through interest payments. Investors can purchase shares of publicly traded REITs on major stock exchanges, such as the New York Stock Exchange, NYSE, or the Nasdaq. Alternatively, investors can invest in non-traded REITs, which are not publicly traded and are only available to accredited investors. While REITs provide several benefits, they also come with risks. One risk is interest rate risk, as rising interest rates can make it more expensive for REITs to borrow money and acquire new properties. Additionally, REITs are subject to market volatility and may experience fluctuations in stock price. Furthermore, because REITs are required to distribute most of the taxable income to shareholders, they may have limited funds available for reinvestment and expansion. In conclusion, REITs are a popular investment vehicle for investors seeking exposure to real estate. They offer several benefits, including steady income streams and liquidity, and can be easily traded on major stock exchanges. However, investors should be aware of the risks associated with REITs, such as interest rate risk and market volatility, and should carefully consider their investment goals and risk tolerance before investing in REITs. Real estate crowdfunding. Real estate crowdfunding is a type of real estate investment that allows multiple investors to pool their resources and invest in a real estate project together. This is typically done through an online platform that connects investors with developers or real estate companies seeking funding for the projects. There are two main types of real estate crowdfunding: debt crowdfunding and equity crowdfunding. Debt crowdfunding involves investors lending money to a real estate developer or company, typically with a fixed interest rate and a predetermined repayment term. Equity crowdfunding, on the other hand, involves investors buying ownership stakes in a real estate project and receiving a share of the profits. Real estate crowdfunding offers several benefits for investors. It provides access to real estate investments that would otherwise be difficult to obtain, as it allows investors to invest in a diverse range of properties and projects with lower minimum investment requirements. Crowdfunding also provides greater transparency, as investors have access to detailed information about the project and its financials. Real estate crowdfunding also offers benefits for developers and real estate companies. It provides an alternative to traditional financing methods, such as bank loans, and can help them raise capital more quickly and efficiently. Additionally, crowdfunding allows developers to reach a wider pool of potential investors and build relationships with them. However, real estate crowdfunding also comes with risks. Investors may be investing in projects with limited information, as some crowdfunding projects may not have a track record or established performance history. Additionally, the risk of fraud is present in any investment, and investors should thoroughly research the platform and the project before investing. In conclusion, real estate crowdfunding is a relatively new form of real estate investment that provides opportunities for investors to invest in a diverse range of properties and projects with lower minimum investment requirements. It also provides developers and real estate companies with an alternative financing method. However, investors should be aware of the risks involved and should thoroughly research the platform and project before investing. Real estate syndication. Real estate syndication is a way for investors to pool their resources and invest in larger real estate projects that would be difficult to fund alone. In a syndication, one individual or company, the syndicator, identifies a real estate opportunity and then invites a group of investors to participate in the project. The syndicator manages the project and is responsible for making decisions on behalf of the investors. There are two main types of real estate syndication: general partnerships and limited partnerships. In a general partnership, all partners have equal decision-making power and are jointly and severally liable for the partnership's debts and obligations. In a limited partnership, there are general partners who manage the project and limited partners who contribute capital but have limited decision-making power and liability. Real estate syndication offers several benefits for investors. It allows them to invest in larger, more complex projects that would be difficult to fund on their own, and to diversify the portfolios across multiple properties and projects. It also provides passive income and tax benefits, as investors can receive a share of the project's profits and depreciation deductions. For syndicators, real estate syndication offers the opportunity to access larger amounts of capital and to build relationships with investors. Syndicators typically receive a portion of the profits as compensation for managing the project. However, real estate syndication also comes with risks. Investors may be investing in projects with limited information, as some syndication projects may not have a track record or established performance history. Additionally, the risk of fraud is present in any investment, and investors should thoroughly research the syndicator and the project before investing. In conclusion, real estate syndication is a way for investors to pool their resources and invest in larger real estate projects that would be difficult to fund alone. It offers benefits such as diversification, passive income, and tax benefits, but also comes with risks that investors should be aware of. Syndicators can access larger amounts of capital and build relationships with investors, but should also ensure they are managing the project in the best interest of their investors. Real estate development. Real estate development is the process of creating new buildings or improving existing ones for commercial or residential use. It involves a series of stages, including land acquisition, financing, design, construction, and leasing or selling the property. Real estate development can be done by individuals, private companies, or public entities such as local governments. One of the first steps in real estate development is identifying a viable piece of land. This requires careful consideration of factors such as location, zoning laws, and potential obstacles such as environmental concerns or community opposition. Once a suitable site is found, developers must secure financing to purchase the land and cover the costs of construction. Design is another crucial stage in real estate development. Developers must work with architects, engineers, and other professionals to create a plan that meets the needs of potential tenants or buyers while also conforming to local regulations and building codes. The design must take into account factors such as the building's intended use, traffic flow, and energy efficiency. After the design is finalized, construction can begin. This involves hiring contractors and overseeing the building process, which can take months or even years to complete. Once the building is finished, developers must attract tenants or buyers through marketing and advertising efforts. Real estate development offers several benefits for both developers and communities. It creates new housing and commercial spaces which can help revitalize neighborhoods and spur economic growth. It also provides jobs in the construction industry and generates tax revenue for local governments. However, real estate development also has some drawbacks. It can have a negative impact on the environment and community, particularly if the project is not carefully planned and executed. It can also lead to increased traffic congestion and strain on local infrastructure. In conclusion, real estate development is a complex process that involves several stages, including land acquisition, financing, design, construction, and leasing or selling the property. It offers many benefits for developers and communities, but also comes with some drawbacks that must be carefully considered. Developers must work with professionals to create plans that are sustainable, attractive, and beneficial for all parties involved. Real estate property management. Property management refers to the operation, control, and oversight of real estate properties, both residential and commercial. Property managers are responsible for maintaining and enhancing the value of the property, while also ensuring that it is well maintained, safe, and secure. One of the primary responsibilities of property management is tenant management. This includes tasks such as screening potential tenants, preparing and signing leases, collecting rent payments, and addressing tenant concerns or complaints. Property managers must also ensure that the property is properly maintained, including regular inspections, repairs, and upkeep. Another important aspect of property management is financial management. Property managers must ensure that rent is collected in a timely manner, and that expenses such as property taxes, insurance, and maintenance costs are paid on time. They also create and manage budgets, and may be responsible for negotiating leases or contracts with service providers. Property managers must also be knowledgeable about relevant laws and regulations related to real estate. This includes zoning laws, building codes, and health and safety regulations. They must also be familiar with landlord-tenant laws and fair housing regulations, and ensure that their actions are in compliance with these laws. Effective communication is also a key component of successful property management. Property managers must communicate effectively with tenants, property owners, and service providers. They must be responsive to tenant concerns and complaints, and ensure that all parties are kept informed of any relevant issues or changes. Technology has become an increasingly important tool in property management. Property managers may use software programs to track rent payments, maintenance requests, and other important data. They may also use social media and other online platforms to advertise properties and communicate with tenants. In conclusion, property management is a complex and multifaceted field that involves a wide range of responsibilities, including tenant management, financial management, compliance with laws and regulations, effective communication, and the use of technology. Effective property management is essential for maintaining and enhancing the value of real estate properties, while also ensuring the safety and well-being of tenants and the surrounding community. Real estate tax implications. Real estate tax implications refer to the various taxes associated with owning, buying, selling, or investing in real estate. These taxes can include property taxes, capital gains taxes, transfer taxes, and others. One of the most common real estate taxes is property tax. Property tax is assessed by local government entities and is based on the value of the property. Property owners typically pay property tax annually, and failure to pay can result in penalties and even foreclosure. Capital gains tax is another real estate tax that may be incurred when selling a property for a profit. This tax is based on the difference between the purchase price and the sale price of the property, and may vary depending on the length of time the property was held before it was sold. Transfer taxes may also be imposed on real estate transactions. These taxes are typically paid by the buyer or seller and are calculated based on the sale price of the property. Transfer taxes can be assessed at the local, state, or federal level. Real estate investors may also be subject to other taxes, such as income tax and estate tax. Income tax may be incurred on rental income generated by the property, while estate tax may be assessed on the value of the property and other assets at the time of the owner's death. To minimize real estate tax liabilities, it is important to have a good understanding of tax laws and regulations. Real estate investors may work with tax professionals to develop strategies for minimizing taxes, such as utilizing tax-advantaged investment vehicles like real estate investment trusts, REITs, or 1031 exchanges. In addition to tax implications, it is important for real estate investors to consider the potential impact of property values and market trends on their investments. Factors such as changes in interest rates, economic conditions, and local development may affect the value of a property and its potential for generating rental income or appreciation. In conclusion, real estate tax implications are a complex and important aspect of real estate ownership and investment. Understanding the various taxes associated with real estate and working with tax professionals can help investors minimize tax liabilities and maximize the potential for financial gain from their investments. Real estate insurance. Real estate insurance is a type of insurance that provides coverage for a wide range of risks associated with owning or investing in real estate. There are several types of real estate insurance, including property insurance, liability insurance, and title insurance. Property insurance is designed to protect real estate owners from financial losses due to damage or destruction to the property. This may include coverage for events such as fire, theft, and natural disasters. Property insurance typically covers the cost of repairs or replacement of the damaged property, and may also provide coverage for personal belongings or other assets located on the property. Liability insurance is designed to protect real estate owners from financial losses resulting from lawsuits or legal claims related to injury or property damage on the property. This may include coverage for events such as slip and fall accidents or damage caused by tenants or guests. Liability insurance typically covers the cost of legal defense and any damages awarded to the plaintiff. Title insurance is designed to protect real estate buyers and lenders from financial losses resulting from defects or issues with the title to the property. This may include issues such as undisclosed liens, disputes over property boundaries, or errors in public records. Title insurance typically covers the cost of legal defense and any damages awarded to the buyer or lender. In addition to these types of insurance, real estate investors may also consider other forms of insurance, such as flood insurance, earthquake insurance, or builder's risk insurance. Real estate insurance is an important consideration for anyone who owns or invests in real estate. Without proper insurance coverage, property owners and investors may be exposed to significant financial risks. Working with an experienced insurance agent or broker can help real estate investors determine the appropriate types and amounts of insurance coverage needed to protect their assets and mitigate potential risks. Real estate market research. Real estate market research involves the collection and analysis of data related to the real estate industry, including trends in property prices, supply and demand, economic indicators, and demographic factors. The goal of market research is to provide real estate investors, developers, and other industry professionals with valuable insights into current and future market conditions. One of the primary reasons for conducting real estate market research is to identify potential investment opportunities. By analyzing data related to property prices, rental rates, vacancy rates, and other market indicators, investors can determine which areas and types of properties may offer the most favorable returns. Market research can also help investors identify emerging trends and potential risks, such as oversupply in a particular market or changing demographics that may impact demand for certain types of properties. Real estate developers may also conduct market research as part of the feasibility study process for new projects. This may involve analyzing data related to population growth, employment trends, and other economic factors to determine whether there is sufficient demand for new housing or commercial developments in a particular area. Market research may also be used by real estate brokers and agents to better understand the needs and preferences of buyers and sellers. By analyzing data related to the types of properties that are in demand, the demographics of buyers and sellers, and other market factors, agents can tailor their services to better meet the needs of the clients. Real estate market research typically involves the collection of data from a variety of sources, including public records, surveys, and industry reports. The data is then analyzed using statistical methods to identify trends and patterns that can inform investment decisions and other business strategies. Overall, real estate market research is an important tool for anyone involved in the real estate industry. By staying informed about current market conditions and emerging trends, real estate professionals can make more informed decisions and maximize their returns on investment. Real estate asset management. Real estate asset management is the process of managing real estate assets on behalf of property owners or investors to maximize their value and returns. The primary goal of asset management is to increase the value of the assets over time, while also ensuring that they are properly maintained and managed to minimize risk and ensure the financial health of the investment. Asset management involves a wide range of activities, including property maintenance and improvement, tenant management, financial analysis and reporting, risk management, and strategic planning. The asset manager is responsible for overseeing all of these activities and ensuring that they are executed effectively and efficiently. One of the key aspects of real estate asset management is property maintenance and improvement. This involves ensuring that the property is well maintained, safe, and attractive to tenants, which can help to increase occupancy rates and rental income. The asset manager is responsible for developing and implementing a maintenance plan, overseeing repairs and upgrades, and ensuring that the property complies with all applicable regulations and standards. Tenant management is another critical component of real estate asset management. This involves finding and retaining tenants, managing lease agreements, and addressing tenant concerns and issues. Effective tenant management can help to reduce vacancy rates, increase rental income, and ensure that tenants are satisfied and likely to renew their leases. Financial analysis and reporting is also an important aspect of real estate asset management. This involves monitoring the financial performance of the property, analyzing market trends and conditions, and developing financial projections and budgets. Regular financial reporting and analysis can help to identify areas of potential risk or opportunity, and inform decision-making around property management and investment strategies. Risk management is another key aspect of real estate asset management. This involves identifying and mitigating potential risks related to the property or investment, such as changes in market conditions or unexpected expenses. Effective risk management strategies can help to minimize potential losses and ensure the long-term financial health of the investment. Finally, strategic planning is an important aspect of real estate asset management. This involves developing and implementing a long-term strategy for the property or investment, based on market trends and conditions, financial projections, and other factors. The asset manager is responsible for developing and executing this strategy, and ensuring that it is aligned with the goals and objectives of the property owner or investor. In summary, real estate asset management is a critical component of successful real estate investment. By effectively managing and optimizing real estate assets, investors can maximize their returns and minimize potential risks, while ensuring the long-term value and financial health of their investment. Real estate property marketing. Real estate property marketing is the process of promoting and advertising real estate properties to potential buyers or tenants. The goal of property marketing is to attract as many qualified prospects as possible to increase the chances of closing a sale or lease agreement. There are various marketing strategies and channels that can be used to promote real estate properties, including traditional and digital marketing techniques. Traditional marketing techniques include methods such as print advertisements in newspapers, brochures, flyers, billboards, and direct mail campaigns. These methods can still be effective in reaching a local audience, especially for properties that are located in highly visible areas. Digital marketing techniques have become increasingly popular in recent years, due to the widespread use of the internet and social media. These methods include online listings on real estate websites, email marketing campaigns, social media advertising, search engine optimization, SEO, and pay-per-click (PPC) advertising. Effective property marketing typically involves a combination of both traditional and digital techniques, depending on the specific property and target audience. One of the key aspects of property marketing is identifying and targeting the right audience. This involves understanding the demographics and preferences of potential buyers or tenants, as well as their motivations and needs. For example, a luxury property may be targeted towards high-income individuals or families, while a commercial property may be targeted towards business owners or investors. Another important aspect of property marketing is highlighting the unique features and benefits of the property. This may include features such as location, amenities, property size, and architecture. Effective property marketing involves presenting these features in a compelling and attractive way to potential buyers or tenants. In addition to promoting the property itself, property marketing may also involve promoting the surrounding area or community. This may include highlighting nearby attractions, schools, and other amenities that can be attractive to potential buyers or tenants. Real estate agents and brokers often play a critical role in property marketing, as they have access to a wide network of potential buyers or tenants. They may use their expertise and relationships to help promote the property to their network, and to advise the property owner on effective marketing strategies. In summary, property marketing is a critical aspect of real estate investment and can have a significant impact on the success of a sale or lease agreement. Effective property marketing involves identifying the right audience, highlighting the unique features and benefits of the property, and utilizing a combination of traditional and digital marketing techniques to promote the property to potential buyers or tenants. Real estate sales strategies. Real estate sales strategies are techniques and tactics used by real estate agents and brokers to sell properties to potential buyers. A successful real estate sales strategy requires a deep understanding of the local market, as well as the needs and preferences of potential buyers. Here are some common real estate sales strategies. 1. Networking. Networking is an essential strategy for real estate agents. It involves building relationships with other agents, industry professionals, and potential buyers. Networking can help agents generate leads and create partnerships that can lead to successful sales. 2. Online marketing. In today's digital age, online marketing is a critical strategy for real estate sales. This involves creating a strong online presence through websites, social media, and other digital platforms. Agents use online marketing to generate leads and promote properties to potential buyers. 3. Open houses. Hosting open houses is a traditional but effective real estate sales strategy. It allows potential buyers to view the property and ask questions in a low-pressure environment. Open houses can generate interest and help agents connect with potential buyers. 4. Personalized approach. A personalized approach is crucial in real estate sales. Agents need to understand the needs and preferences of potential buyers and tailor their approach accordingly. This may involve showcasing specific features of the property, providing relevant information about the neighborhood, or addressing specific concerns of the buyer. 5. Referrals. Referrals are a powerful sales strategy in real estate. Happy clients can refer the friends and family to their agent, generating new leads and potential sales. 6. Pricing strategy. Pricing is a critical factor in real estate sales. Agents need to understand the local market and price the property appropriately to generate interest and attract potential buyers. Overpricing can deter buyers, while underpricing can result in lost profits. 7. Staging. Staging is the process of preparing the property for sale by making it more attractive to potential buyers. This may involve decluttering, rearranging furniture, and adding decorative elements to create a welcoming and inviting atmosphere. In summary, real estate sales strategies involve a combination of networking, online marketing, open houses, personalized approaches, referrals, pricing strategies, and staging. Successful real estate agents understand the needs and preferences of potential buyers and use a variety of strategies to promote the property and generate interest. Real estate negotiations. Real estate negotiations refer to the process of reaching an agreement between buyers and sellers regarding the terms of a real estate transaction. Negotiations can be complex and challenging, as they involve multiple parties with different interests and objectives. Successful real estate negotiations require strong communication skills, strategic thinking, and a deep understanding of the real estate market. Here are some key factors that can impact real estate negotiations. 1. Market conditions. The state of the real estate market can significantly impact negotiations. In a seller's market, where demand exceeds supply, buyers may need to be more flexible with their offers to remain competitive. In a buyer's market, where supply exceeds demand, sellers may need to be more flexible with their asking price to attract buyers. 2. Property condition. The condition of the property can also impact negotiations. If the property requires significant repairs or renovations, buyers may negotiate a lower price or ask for concessions. If the property is in excellent condition, sellers may be less willing to negotiate. 3. Motivation. The motivation of the parties involved can also impact negotiations. If the seller is motivated to sell quickly, they may be more willing to negotiate on price or other terms. If the buyer is motivated to purchase the property, they may be willing to pay a higher price. 4. Financing. The financing options available to buyers can also impact negotiations. Buyers with pre-approved financing may be in a stronger negotiating position than buyers who have not secured financing. 5. Time frame. The time frame for the transaction can also impact negotiations. If the parties need to complete the transaction quickly, they may be willing to compromise on certain terms to expedite the process. Here are some negotiation strategies that real estate agents may use. 1. Active listening. Active listening involves paying attention to the other party's needs and concerns and responding accordingly. This can help agents build rapport and trust with the other party and increase the chances of a successful negotiation. 2. Setting realistic goals. Setting realistic goals is essential in real estate negotiations. Agents need to understand the needs and objectives of the clients and set achievable goals that align with their interests. 3. Offering creative solutions. Offering creative solutions can help agents find common ground with the other party and reach an agreement that benefits both parties. 4. Communicating effectively. Effective communication is critical in real estate negotiations. Agents need to be clear and concise when presenting offers and responding to counteroffers. 5. Maintaining a professional demeanor. Maintaining a professional demeanor is essential in real estate negotiations. Agents need to remain calm and composed, even in challenging situations, to avoid jeopardizing the negotiation process. In summary, real estate negotiations involve multiple factors, including market conditions, property condition, motivation, financing, and time frame. Successful negotiations require strong communication skills, strategic thinking, and a deep understanding of the real estate market. Real estate agents use a variety of strategies, including active listening, setting realistic goals, offering creative solutions, communicating effectively, and maintaining a professional demeanor, to achieve successful outcomes. Real estate contract. Real estate contract law refers to the legal rules and regulations that govern the creation, interpretation, and enforcement of contracts related to the sale, purchase, lease, or other transfer of real estate property. These contracts are legally binding agreements between parties that outline the terms and conditions of the transaction. Real estate contract law can be complex and varied, as it involves both common law principles and statutory provisions that vary by jurisdiction. Here are some important aspects of real estate contract law to consider. 1. Formation of the contract. A valid contract requires an offer, acceptance, and consideration. The offer must be communicated clearly and contain all essential terms, while the acceptance must be unconditional and unequivocal. 2. Contractual provisions. Real estate contracts typically include provisions related to the purchase price, closing date, contingencies, title insurance, and other terms and conditions that are specific to the transaction. 3. Statutory disclosures. In many jurisdictions, real estate contracts must include certain statutory disclosures related to the property's condition, zoning restrictions, and environmental hazards, among other things. 4. Title and property condition. The contract may include provisions related to title searches, title insurance, property inspections, and other matters that impact the condition and value of the property. 5. Performance and breach. If either party fails to perform its obligations under the contract, the other party may have a right to specific performance, damages, or other remedies. 6. Dispute resolution. Real estate contracts often include provisions related to dispute resolution, such as arbitration or mediation, to resolve any disagreements that may arise during the transaction. 7. Legal requirements. Real estate contract law also requires compliance with various legal requirements, such as fair housing laws, truth in lending laws, and other consumer protection statutes. In summary, real estate contract law is an important aspect of real estate transactions. It governs the creation, interpretation, and enforcement of legally binding agreements related to the transfer of real estate property, and includes provisions related to contractual formation, statutory disclosures, property condition, performance and breach, dispute resolution, and legal requirements. Real estate disputes resolution. Real estate disputes are common, and can arise in various situations, such as disputes over the purchase, sale, lease, or management of real estate property. Real estate dispute resolution involves methods for resolving these conflicts outside of the courtroom, with the goal of avoiding costly and time-consuming litigation. Here are some common methods of real estate dispute resolution. 1. Negotiation. Negotiation is a direct method of dispute resolution where parties attempt to resolve the differences through communication and compromise. This can involve informal discussions or formal negotiations facilitated by a mediator or other neutral third party. 2. Mediation. Mediation is a form of alternative dispute resolution (ADR), where a neutral third party, the mediator, facilitates communication and negotiation between parties to help them reach a mutually acceptable solution. Mediation can be voluntary or court-ordered, and is generally less formal and less costly than litigation. 3. Arbitration. Arbitration is another form of ADR where parties agree to submit the dispute to a neutral third party, the arbitrator, who will make a binding decision on the matter. Arbitration can be less formal and less expensive than litigation, but the decision is final and binding, and there are limited rights to appeal. 4. Litigation. Litigation involves resolving a dispute through the court system. This can be a lengthy and expensive process, but it is sometimes necessary when other methods of dispute resolution are not successful. In addition to these methods, there are also specialized methods of real estate dispute resolution, such as construction dispute resolution, landlord-tenant dispute resolution, and foreclosure dispute resolution. These methods involve specific legal procedures and may require specialized knowledge and expertise. It is important to note that the choice of dispute resolution method depends on various factors, including the nature and complexity of the dispute, the relationship between the parties, the desired outcome, and the costs and time involved. Real estate professionals should be familiar with the various methods of dispute resolution and the benefits and drawbacks, and should be prepared to advise clients on the best course of action for the specific situation. Real estate property inspection. Property inspection is an important step in the real estate acquisition process that involves a thorough evaluation of the condition and quality of a property. A property inspection can reveal potential issues or defects that may impact the value, safety, or livability of the property. Here are some key aspects of property inspection. 1. Purpose. The purpose of a property inspection is to identify any existing or potential issues with the property. The inspector will examine various aspects of the property, such as the roof, foundation, plumbing, electrical, heating and cooling systems, and other structural components. The inspection can help the buyer make an informed decision about whether to proceed with the purchase and can also help negotiate the purchase price or request repairs. 2. Process. Property inspections are typically performed by licensed home inspectors who are trained to identify potential issues with the property. The inspection may take several hours or more, depending on the size and complexity of the property. The inspector will usually provide a written report of the findings, which can be shared with the buyer and used in negotiations with the seller. 3. Types of inspections. There are several types of property inspections that can be performed depending on the property type and specific needs of the buyer. Some common types of inspections include general home inspection. This is a comprehensive inspection of the property that examines all major systems and components. Pest inspection. This type of inspection looks for signs of pest infestations, such as termites or rodents. Radon inspection. This type of inspection tests for the presence of radon gas, which can be harmful to human health. Mold inspection. This type of inspection looks for signs of mold growth, which can cause health issues and damage to the property. 4. Importance. Property inspections are an important step in the real estate acquisition process because they can uncover potential issues that may not be apparent to the buyer. Inspections can help buyers make informed decisions about the property and avoid costly repairs or renovations down the road. Additionally, inspections can provide valuable information that can be used in negotiations with the seller to ensure that the buyer is getting a fair deal. In summary, property inspection is a critical step in the real estate acquisition process that can provide valuable information about the condition and quality of a property. Buyers should carefully consider the type and scope of inspection that is appropriate for their needs and should work with a licensed inspector to ensure a thorough and accurate evaluation of the property. Real estate investment portfolio management. Real estate investment portfolio management involves the management and optimization of a portfolio of real estate assets to maximize returns and minimize risks. Real estate investment portfolios can include a wide range of properties, such as residential, commercial, industrial, and mixed-use properties, and can be owned directly or indirectly through vehicles such as real estate investment trusts, REITs. Effective real estate investment portfolio management requires a holistic approach that considers various factors, such as market trends, property performance, financing options, and tax implications. The following are some key elements of real estate investment portfolio management. 1. Portfolio analysis. The first step in managing a real estate investment portfolio is to analyze the current portfolio holdings to determine their performance and potential for growth. This analysis should include an assessment of the portfolio's risk profile, cash flow, and overall return on investment. 2. Diversification. Diversification is an important strategy in real estate portfolio management. By investing in a variety of property types and locations, investors can minimize risk and reduce exposure to market fluctuations. 3. Property selection. When selecting properties for a real estate investment portfolio, investors should consider factors such as location, property type, tenant quality, and potential for appreciation. Careful due diligence is essential to ensure that the properties meet the investor's financial objectives and risk tolerance. 4. Financing. Real estate investment portfolio management involves selecting the most appropriate financing options to maximize returns and minimize risks. This may involve securing traditional bank financing, using private equity, or utilizing tax-advantaged vehicles such as REITs. 5. Tax planning. Real estate investment portfolios can have complex tax implications. Effective tax planning can help investors minimize tax liabilities and maximize returns. This may involve utilizing tax-deferred exchange programs, taking advantage of depreciation deductions, or structuring investments through tax-advantaged vehicles such as REITs. 6. Asset management. Once properties are selected and acquired, effective asset management is essential to maximize returns and minimize risks. This may involve property maintenance, tenant management, lease negotiation, and rent collection. 7. Performance measurement. To monitor the success of a real estate investment portfolio, investors should regularly evaluate its performance. This includes assessing financial metrics such as net operating income, cash flow, and return on investment. In conclusion, real estate investment portfolio management requires a comprehensive and strategic approach to maximize returns and minimize risks. By considering factors such as market trends, property performance, financing options, and tax implications, investors can build and manage a successful real estate investment portfolio. Real estate investment analysis. Real estate investment analysis involves evaluating the financial viability of a real estate investment opportunity. This analysis is important because it helps investors determine whether a property will generate the expected returns and whether it is worth investing in. The following are some of the key components of real estate investment analysis. 1. Market analysis. This involves evaluating the market conditions in the area where the property is located, including factors such as demographics, supply and demand, and economic conditions. This information helps investors determine the potential rental income and appreciation of the property. 2. Financial analysis. This involves analyzing the financial performance of the property, including the potential income and expenses, cash flow projections, and return on investment. The analysis helps investors determine the feasibility of the investment and whether it will meet the financial objectives. 3. Risk analysis. This involves assessing the risks associated with the investment, including market risks, credit risks, and operational risks. Investors need to consider the potential risks and their likelihood of occurrence when making investment decisions. 4. Property analysis. This involves evaluating the physical condition and potential of the property, including its location, amenities, and potential for improvement. The analysis helps investors determine the potential rental income and resale value of the property. 5. Exit strategy. This involves developing a plan for selling or disposing of the property in the future. Investors need to consider their long-term goals and the potential market conditions when developing an exit strategy. Overall, real estate investment analysis is a crucial component of real estate investing. It helps investors make informed decisions, minimize risks, and maximize returns on their investments. Real estate investment risk management. Real estate investment risk management involves identifying potential risks associated with real estate investments and developing strategies to mitigate or manage those risks. Some common risks associated with real estate investments include market risks, financial risks, operational risks, and legal and regulatory risks. The following are some strategies for managing real estate investment risks. 1. Diversification. One way to mitigate risk is to diversify the portfolio by investing in different types of properties, in different locations, and with different risk profiles. This reduces the impact of any single investment or market downturn. 2. Due diligence. Thorough due diligence is critical in identifying potential risks and assessing the investment opportunity. This includes researching the property, the market, and the seller, as well as performing a property inspection and evaluating the financials. 3. Risk assessment. Conducting a risk assessment helps identify potential risks and their likelihood of occurrence. This allows investors to prioritize risks and develop strategies to manage them. 4. Contingency planning. Investors should have contingency plans in place in case of unexpected events, such as market downturns, property damage, or tenant issues. This includes having adequate insurance coverage, cash reserves, and alternative exit strategies. 5. Active management. Active management of the property and the investment portfolio can help mitigate risks and maximize returns. This includes monitoring market trends, tenant relationships, and property maintenance. 6. Legal and regulatory compliance. Ensuring compliance with local laws and regulations is critical in minimizing legal and regulatory risks. This includes obtaining all necessary permits and licenses, adhering to zoning regulations, and complying with landlord-tenant laws. Overall, effective risk management is an essential component of real estate investing. By identifying potential risks and developing strategies to manage them, investors can minimize their exposure to risk and maximize their returns on investment. Real estate investment performance measurement. Real estate investment performance measurement is a crucial process for evaluating the effectiveness and profitability of real estate investments. This process involves tracking and analyzing various financial metrics and performance indicators to determine the success or failure of a real estate investment. Here are some key areas to consider when evaluating real estate investment performance. 1. Cash flow. Cash flow is the net amount of cash generated from a real estate investment after all expenses have been paid. It is important to track the cash flow over time to assess whether the investment is generating sufficient income to cover expenses and provide a return on investment. 2. Return on investment (ROI). ROI measures the profitability of a real estate investment relative to the amount of capital invested. This metric is calculated by dividing the profit or loss generated by the investment by the amount of capital invested. 3. Capitalization rate. The capitalization rate, or cap rate, is a measure of the return on investment based on the property's net operating income (NOI) relative to the purchase price. It is calculated by dividing the property's annual NOI by its purchase price. 4. Gross rent multiplier (GRM). GRM is a quick and easy way to assess the potential profitability of a rental property. It is calculated by dividing the property's purchase price by its gross annual rental income. 5. Internal rate of return (IRR). IRR is a measure of the rate of return that an investment is expected to generate over its lifetime. It takes into account the time value of money and considers all cash flows generated by the investment, including the initial investment, ongoing cash flows, and the eventual sale of the property. 6. Debt service coverage ratio (DSCR). DSCR is a measure of the property's ability to generate sufficient income to cover its debt payments. It is calculated by dividing the property's net operating income by its annual debt service. 7. Occupancy rate. Occupancy rate measures the percentage of a property's units that are occupied at any given time. This metric is important for assessing the property's ability to generate rental income and maintain cash flow. 8. Appreciation. Appreciation measures the increase in the value of a property over time. It is an important factor to consider when evaluating long-term real estate investments. Overall, evaluating real estate investment performance requires a deep understanding of various financial metrics and performance indicators. Investors must track and analyze these metrics over time to make informed decisions about their real estate investments and ensure long-term profitability. Real estate investment exit strategies. Real estate investment exit strategies refer to the plans or tactics used by real estate investors to liquidate the property holdings and realize profits. Investors typically have different reasons for selling the property, such as maximizing returns, reducing risk, or shifting investment focus. Below are some of the commonly used exit strategies in real estate investment. 1. Flip. This strategy involves purchasing a property, renovating or improving it, and then selling it for a profit. The goal is to quickly buy low and sell high, often within a short period, usually less than a year. 2. Buy and hold. This strategy involves purchasing a property with the intention of holding it for a longer period, typically 5 to 10 years. The goal is to generate rental income and hold the property until it appreciates in value, allowing the investor to sell for a higher price. 3. Refinance. In this strategy, the investor takes out a new loan on an existing property to pay off the initial loan and release some equity. This can provide immediate cash flow and allows the investor to hold onto the property for longer while still realizing some profits. 4. Sale-leaseback. This strategy involves selling a property to a buyer who then leases it back to the seller, who continues to occupy the property as a tenant. This strategy can provide the seller with immediate cash flow and reduce the risks associated with owning property. 5. 1031 exchange. This strategy allows investors to defer paying capital gains tax by reinvesting the proceeds from the sale of one property into the purchase of another similar property. The investor must adhere to strict IRS rules and timelines to execute a 1031 exchange. 6. Partnership buyout. In this strategy, one partner buys out the other partner's share in the property. This can allow for a smooth transition in ownership and provide liquidity for one partner while allowing the other to maintain control over the property. 7. Auction. This strategy involves selling a property through a public auction. Auctions can generate a sense of urgency among potential buyers and result in a quick sale. Real estate investors should have a clear understanding of their investment objectives and risk tolerance before choosing an exit strategy. It is also important to have a backup plan in case the initial exit strategy does not work out. Ultimately, a successful exit strategy should allow the investor to achieve their investment goals while minimizing risks and maximizing returns. Real estate investment diversification. Real estate investment diversification is a strategy that aims to reduce risk by spreading investments across different types of properties or real estate assets. The goal is to create a portfolio that is less vulnerable to market fluctuations, economic changes, and other external factors that could negatively impact any single investment. One of the key benefits of real estate investment diversification is risk mitigation. By investing in different types of properties, such as residential, commercial, and industrial, as well as in different locations, an investor can spread their risk and reduce the likelihood of suffering significant losses from any one investment. This is especially important in volatile or uncertain economic climates where one sector or location may be more adversely affected than others. Another benefit of diversification is the potential for increased returns. Different types of real estate investments may perform better or worse at different times. By having a diversified portfolio, investors may be able to capture higher returns by shifting their focus to the most profitable sectors or locations at any given time. There are several ways to achieve diversification in real estate investment. One way is to invest in real estate investment trusts, REITs, which own and manage a portfolio of properties across various sectors and locations. Another way is to invest in a real estate mutual fund or exchange-traded fund (ETF), which can provide exposure to a diversified basket of real estate assets. Investors can also achieve diversification by investing directly in properties across different sectors and locations. This may involve purchasing multiple properties or investing in a real estate syndication, where multiple investors pool the funds together to purchase larger, more expensive properties. However, it's important to note that diversification alone does not guarantee success or prevent losses in real estate investment. It's still important for investors to conduct thorough due diligence, monitor market trends, and make informed investment decisions based on their investment goals and risk tolerance. Real estate investment decision making. Real estate investment decision making involves a process of analyzing potential investments to determine their feasibility and profitability. The decision making process can vary depending on the investor's goals and investment strategy. But there are some common factors that investors consider when making real estate investment decisions. One of the key factors that investors consider is the location of the property. The location can affect the property's potential rental income, resale value, and overall demand. Investors may also consider the local real estate market conditions, such as trends in supply and demand, vacancy rates, and rental rates. Another factor that investors consider is the property's condition and potential for renovation or improvement. A property that requires significant repairs or upgrades may offer potential for value-add investment strategies, but it also presents more risk and may require more time and resources to manage. Investors also evaluate the financing options available for the property, such as traditional mortgages, private loans, or cash purchases. The financing strategy can affect the overall return on investment and the investor's risk exposure. In addition to these factors, investors also consider their own risk tolerance and investment goals. Some investors may prefer lower risk, stable investments with consistent cash flow, while others may seek higher risk, high reward opportunities with the potential for greater returns. To make informed real estate investment decisions, investors may conduct market research, analyze financial data and projections, assess risk and return potential, and consult with real estate professionals such as brokers, appraisers, and property managers. It is important for investors to have a thorough understanding of the real estate market and investment strategies, as well as a disciplined approach to evaluating potential investments and managing their portfolio. Real estate investment goals and objectives. Real estate investment goals and objectives are critical elements of any successful investment strategy. Investing in real estate requires careful consideration of various factors to achieve the desired outcomes. Here, we will explore some of the most common real estate investment goals and objectives. 1. Cash flow. Cash flow is a crucial consideration for real estate investors. It refers to the income generated from the property after all the expenses have been paid. Positive cash flow is when the rental income exceeds the expenses, while negative cash flow is when the expenses are more than the rental income. Cash flow is a crucial factor for investors looking to earn regular income from their real estate investment. 2. Appreciation. Appreciation refers to the increase in the value of the property over time. Real estate investors look for properties that appreciate over time, and they often use the appreciation to build equity. Appreciation can be influenced by factors such as location, economic conditions, and demand for the property. 3. Tax benefits. Real estate investments offer various tax benefits that can help investors save money on the taxes. For instance, rental income is generally subject to lower tax rates than other forms of income, and investors can deduct expenses such as property taxes, mortgage interest, and repairs from the taxable income. 4. Diversification. Diversification is another key investment objective for real estate investors. Investing in multiple properties, locations, or types of real estate can help to spread the risk and minimize potential losses. 5. Capital appreciation. Capital appreciation is the increase in the property's value over time. Investors seek to buy properties that are likely to appreciate in value and sell them for a profit in the future. Capital appreciation can be influenced by various factors such as location, economic conditions, and supply and demand. 6. Hedge against inflation. Real estate investments are considered a hedge against inflation because the value of the property tends to increase with inflation. As inflation rises, so do rents, property values, and the income generated from the property. 7. Retirement planning. Real estate investments can also be used as a tool for retirement planning. Investors can use the rental income generated from the properties to fund their retirement or sell the properties for a profit. In conclusion, setting clear investment goals and objectives is crucial for real estate investors. Whether it's cash flow, appreciation, tax benefits, diversification, capital appreciation, hedging against inflation, or retirement planning, understanding what you want to achieve with your investment can help you make informed decisions and achieve your desired outcomes. Real estate investment budgeting and forecasting. Real estate investment budgeting and forecasting involves estimating the financial resources needed and the expected returns on investment for a real estate project. It is a critical component of real estate investment analysis and decision making. To begin with, it is important to establish the investment objectives, which could include income generation, capital appreciation, or a combination of both. This helps to determine the investment strategy and the appropriate financial metrics to measure success. Once the investment objectives are established, a budget and financial plan can be developed. The budgeting process involves estimating the costs associated with acquiring, developing, operating, and maintaining the property. This could include expenses such as purchase price, closing costs, renovation and repair costs, property taxes, insurance, utilities, property management fees, and other costs associated with owning and operating the property. A thorough understanding of these costs is essential to accurately forecast the expected cash flows and returns on investment. Forecasting the expected returns on investment involves estimating the revenue generated by the property over time. This could include rental income, sale proceeds, and other sources of revenue. Accurately forecasting revenue requires an understanding of the local real estate market and economic conditions, as well as the specific characteristics of the property and its potential uses. In addition to estimating costs and revenue, it is important to consider potential risks and uncertainties associated with the investment. This could include market volatility, changes in interest rates, regulatory changes, and unexpected expenses. Developing contingency plans and incorporating risk mitigation strategies into the financial plan can help to reduce the impact of these risks on the investment performance. Real estate investment budgeting and forecasting is an ongoing process that should be periodically reviewed and updated as market conditions and investment objectives change. It is a critical component of successful real estate investment, and can help investors make informed decisions and maximize returns on investment. Real estate investment monitoring and evaluation. Real estate investment monitoring and evaluation refers to the process of tracking and assessing the performance of an investment in real estate over time. The goal of monitoring and evaluation is to ensure that the investment is meeting its objectives and to identify any areas that may require changes or improvements. There are several key elements involved in real estate investment monitoring and evaluation, including 1. Performance metrics. Establishing clear performance metrics is essential to monitor the success of a real estate investment. These metrics can include metrics such as cash flow, occupancy rates, net operating income, and return on investment. 2. Data collection and analysis. Collecting data on the performance of a real estate investment and analyzing it to identify trends and patterns is essential to make informed decisions about the investment. This data can come from a variety of sources, including property management reports, financial statements, and market research reports. 3. Regular reporting. Regular reporting is an important aspect of real estate investment monitoring and evaluation. This can include monthly or quarterly reports on the performance of the investment, as well as annual reports that summarize the investment's overall performance. 4. Risk management. Real estate investment monitoring and evaluation should also include risk management strategies. This can include identifying potential risks and developing plans to mitigate them, as well as ensuring that adequate insurance coverage is in place to protect against unforeseen events. 5. Adjustments and optimization. Based on the data collected and analyzed, adjustments and optimization may be necessary to ensure that the investment is meeting its objectives. This could include making changes to the investment strategy, adjusting rents or lease terms, or making capital improvements to the property. Overall, real estate investment monitoring and evaluation is essential to ensure that an investment in real estate is successful over the long term. By establishing clear performance metrics, collecting and analyzing data, regularly reporting on performance, managing risks, and making adjustments as necessary, investors can maximize the potential returns of their real estate investments. Real estate investment regulations. Real estate investment is subject to various regulations and laws that govern the process of buying, selling, and managing real estate assets. These regulations can vary depending on the country and jurisdiction where the property is located. In general, real estate investment regulations are designed to protect the interests of investors and ensure the integrity of the real estate market. Here are some of the key areas where real estate investment regulations may apply. 1. Property ownership and transfer. Regulations govern the transfer of ownership from one party to another, such as through the sale or purchase of a property. This includes laws around property titles, deeds, and other legal documents required to transfer ownership. 2. Zoning and land use. Zoning laws determine how properties can be used in specific areas, such as residential, commercial, or industrial use. These laws also regulate the construction and development of new buildings and structures. 3. Environmental regulations. Environmental regulations may apply to real estate investment when the property is located in areas with sensitive ecosystems or where there are concerns around pollution or waste management. Investors may need to comply with environmental impact assessments or obtain permits to operate on a particular property. 4. Taxation. Real estate investment is subject to various taxes, including property taxes, capital gains taxes, and income taxes. Tax laws and regulations can vary widely depending on the country and jurisdiction. 5. Consumer protection laws. In some countries, consumer protection laws may apply to real estate investment to ensure that investors are not misled or defrauded. These laws may regulate the disclosure of information to investors, the handling of investor funds, and the conduct of real estate agents and brokers. 6. Mortgage and finance regulations. Regulations may apply to the financing of real estate investments, such as through mortgages or other loans. These laws may include requirements around creditworthiness, interest rates, and loan terms. 7. Foreign investment regulations. In some countries, there may be restrictions on foreign ownership of real estate assets, or additional regulations that apply to foreign investors. Real estate investors need to be aware of the relevant regulations and laws that apply to their investments, to ensure that they are compliant and avoid any legal issues. In some cases, investors may need to consult with legal or financial professionals to ensure that they are operating within the bounds of the law. Real estate investment ethics. Real estate investment ethics refer to the moral principles and standards that guide the behavior and actions of real estate investors. Real estate investors have a responsibility to act ethically and responsibly when investing in real estate. The following are some of the key aspects of real estate investment ethics. 1. Honesty. Real estate investors must be honest and transparent in all the dealings. They should not engage in deceptive practices such as misrepresentation or concealment of important information. 2. Fairness. Real estate investors should treat all parties involved in a transaction fairly and equitably. They should not use their power or influence to gain an unfair advantage over others. 3. Respect. Real estate investors should show respect for the rights and interests of others, including tenants, neighbors, and the community at large. 4. Compliance. Real estate investors should comply with all applicable laws, regulations, and ethical standards in the conduct. They should not engage in illegal or unethical activities such as bribery, fraud, or money laundering. 5. Social responsibility. Real estate investors have a responsibility to contribute to the well-being of society and the environment. They should consider the social and environmental impacts of their investments and take steps to mitigate any negative effects. 6. Confidentiality. Real estate investors must respect the confidentiality of information obtained in the course of the business dealings. They should not disclose confidential information without proper authorization. 7. Professionalism. Real estate investors should act in a professional manner at all times, maintaining the highest standards of integrity and ethical conduct. Adhering to ethical principles in real estate investment is important for building trust and credibility with stakeholders, promoting a positive image of the industry, and achieving long-term success and sustainability. Real estate investment decision-making tools. Real estate investment decision-making is a critical process that requires careful consideration of various factors such as market trends, risks, financing options, and investment objectives. To assist in making informed decisions, real estate investors have access to various decision-making tools. In this section, we will discuss some of the commonly used tools in real estate investment decision-making. 1. Cash flow analysis. Cash flow analysis is a tool used to evaluate the financial feasibility of a real estate investment. It involves projecting the cash inflows and outflows of an investment over a specified period, usually 5 to 10 years. The objective is to determine the net present value (NPV) and internal rate of return (IRR) of the investment, which are critical measures of profitability and financial viability. 2. Market analysis. Market analysis is a tool used to evaluate the supply and demand dynamics of a real estate market. It involves analyzing various market indicators such as population growth, employment rates, vacancy rates, and rental rates. The objective is to determine the market conditions and identify potential investment opportunities. 3. Risk analysis. Risk analysis is a tool used to evaluate the potential risks associated with a real estate investment. It involves identifying and assessing various risks such as market risk, credit risk, liquidity risk, and operational risk. The objective is to determine the likelihood and impact of these risks on the investment. 4. Sensitivity analysis. Sensitivity analysis is a tool used to evaluate the sensitivity of an investment to changes in critical variables such as interest rates, vacancy rates, and rental rates. It involves adjusting these variables to determine the impact on the investment's financial performance. The objective is to assess the investment's resilience to changes in market conditions and identify potential risks. 5. Portfolio analysis. Portfolio analysis is a tool used to evaluate the performance of a real estate investment portfolio. It involves assessing the diversification, risk, and return characteristics of the portfolio. The objective is to identify potential investment opportunities and optimize the portfolio's performance. 6. Capitalization rate analysis. Capitalization rate analysis is a tool used to evaluate the value of a real estate investment. It involves determining the capitalization rate, which is the rate of return that a property generates based on its net operating income (NOI). The objective is to determine the fair market value of the investment and assess its financial viability. 7. Investment property scorecard. The investment property scorecard is a tool used to evaluate the financial viability of a real estate investment. It involves scoring various investment criteria such as location, property type, financing options, and market conditions. The objective is to determine the investment's potential return on investment (ROI) and identify potential investment opportunities. In conclusion, real estate investment decision-making tools are critical in evaluating the financial viability, risks, and returns of a real estate investment. The tools discussed in this section can assist real estate investors in making informed investment decisions and optimizing the performance of their investment portfolios. However, it is essential to use these tools in conjunction with other due diligence measures, such as property inspection, market research, and legal review, to minimize risks and maximize returns. Real estate investment decision-making criteria. Real estate investment decision-making criteria refer to the factors that investors consider when making decisions about investing in real estate. These criteria help investors to evaluate the potential profitability and risks associated with a real estate investment opportunity. Some of the most common criteria used in real estate investment decision-making are: 1. Location. The location of a property is one of the most important criteria when it comes to real estate investment. Investors look for properties in desirable neighborhoods that have good transportation links, access to amenities, and low crime rates. 2. Property type. Investors also consider the type of property they want to invest in. Some prefer to invest in residential properties, while others prefer commercial properties or industrial properties. 3. Property condition. The condition of a property is another important criterion. Investors evaluate the condition of a property to determine if it needs repairs or renovations, and if so, how much it will cost to make those repairs. 4. Cash flow. Cash flow is the amount of money generated by a property after all expenses have been paid. Investors evaluate the cash flow potential of a property to determine its profitability. 5. Rental income. Rental income is a critical factor for investors who invest in rental properties. Investors evaluate the potential rental income of a property to determine its profitability. 6. Capital appreciation. Capital appreciation refers to the increase in the value of a property over time. Investors evaluate the potential for capital appreciation to determine the long-term profitability of a property. 7. Financing options. Investors also consider financing options when evaluating real estate investment opportunities. They evaluate the interest rates, down payment requirements, and other terms and conditions of financing options to determine the feasibility of a deal. 8. Market trends. Market trends, such as supply and demand, vacancy rates, and rental rates, can also impact real estate investment decision-making. Investors evaluate these trends to determine the potential profitability of a property. 9. Exit strategy. Investors consider their exit strategy when evaluating real estate investment opportunities. They evaluate options such as selling the property, refinancing, or holding onto it for the long term. 10. Risks. Finally, investors evaluate the risks associated with a real estate investment opportunity. They consider factors such as market volatility, economic conditions, and legal and regulatory risks. By evaluating these criteria, investors can make informed decisions about real estate investment opportunities and maximize their returns while minimizing their risks. Real estate investment data analysis. Real estate investment data analysis involves the use of various tools and techniques to examine and evaluate market trends, property performance, and investment opportunities. In today's digital age, investors have access to a wide range of data sources and analytical tools that can help them make informed investment decisions. One of the most important sources of real estate investment data is market research. This involves collecting and analyzing data on supply and demand trends, market conditions, and pricing dynamics. Market research can help investors identify potential investment opportunities and make informed decisions on when and where to invest. Another important source of data is property performance metrics. These include occupancy rates, rental income, and net operating income (NOI). By analyzing these metrics, investors can gain insights into the performance of specific properties and make informed decisions on whether to buy, sell, or hold. Real estate investment data analysis also involves the use of financial models to project the future performance of a property or portfolio. These models typically use a range of inputs, including historical performance data, market trends, and economic forecasts, to generate projections of future cash flows and returns. By comparing the projected returns to the required rate of return, investors can determine whether a particular investment opportunity meets their investment goals. In addition to financial models, real estate investors also use a range of other analytical tools to evaluate investment opportunities. These include sensitivity analysis, which examines the impact of changing key assumptions on the projected returns, scenario analysis, which evaluates the performance of a property or portfolio under different market conditions, and Monte Carlo simulation, which generates thousands of random scenarios to estimate the probability of different investment outcomes. To effectively analyze real estate investment data, investors must have a strong understanding of finance, economics, and statistical analysis. They must also have access to reliable data sources and the analytical tools needed to effectively evaluate investment opportunities. By using these tools and techniques, real estate investors can make informed decisions that help them achieve their investment goals while managing risk. Real estate investment performance metrics. Real estate investment performance metrics are used to evaluate the financial performance of real estate investments. These metrics can help investors determine whether a real estate investment is a good opportunity for them or not. Here are some of the most commonly used real estate investment performance metrics. 1. Capitalization rate. Cap rate. Cap rate is a ratio that measures the return on investment for a real estate property. It is calculated by dividing the net operating income (NOI) of a property by its current market value. The cap rate is often used to determine the value of a property and compare it to similar properties in the market. 2. Cash-on-cash return. COC. COC is a ratio that measures the cash income earned on an investment relative to the amount of cash invested. It is calculated by dividing the annual cash flow from a property by the amount of cash invested. This metric is useful for evaluating the cash flow potential of a property and comparing it to other investment opportunities. 3. Internal rate of return. IRR. IRR is a metric that measures the rate of return that an investment is expected to generate over a period of time. It takes into account the time value of money and the cash flows of an investment. IRR is often used to compare different investment opportunities and determine the most profitable one. 4. Return on investment. ROI. ROI is a metric that measures the return on investment for a property over a specific period of time. It is calculated by dividing the profit or loss of an investment by the initial investment amount. This metric is useful for evaluating the profitability of a property and comparing it to other investment opportunities. 5. Debt service coverage ratio. DSCR. DSCR is a ratio that measures the ability of a property to generate enough income to cover its debt obligations. It is calculated by dividing the property's net operating income by its total debt service payments. This metric is important for lenders to evaluate the risk of a property and determine the amount of debt they are willing to provide. 6. Gross rent multiplier. GRM. GRM is a ratio that measures the value of a property relative to its rental income. It is calculated by dividing the property's market value by its gross annual rental income. This metric is often used to compare the value of a property to similar properties in the market. 7. Operating expense ratio. OA. OA is a ratio that measures the operating expenses of a property relative to its gross operating income. It is calculated by dividing the operating expenses by the gross operating income. This metric is useful for evaluating the efficiency of a property's management and comparing it to similar properties in the market. Real estate investment performance metrics are important for investors to evaluate the financial performance of their real estate investments. These metrics can help investors make informed decisions and maximize their returns on investment. Real estate investment performance measurement methods. Real estate investment performance can be measured using various methods that provide investors with different types of information about their investment. Below are some of the common methods of measuring real estate investment performance. 1. Cash-on-cash return. This method measures the cash income earned on the initial investment in a property. It is calculated by dividing the annual net cash flow by the total equity investment. 2. Capitalization rate. Cap rate. Cap rate is used to estimate the potential return on an investment property by calculating the ratio between the net operating income and the property value. 3. Internal rate of return (IRR). This method calculates the total return on an investment by taking into account the time value of money and the cash flows generated by the investment. 4. Net present value (NPV). NPV measures the present value of future cash flows, taking into account the time value of money and the initial investment. 5. Gross rent multiplier (GRM). GRM is a quick and easy method to estimate the potential return on an investment property by dividing the property value by the gross rental income. 6. Return on investment (ROI). ROI is a simple method that calculates the percentage return on an investment by dividing the net profit by the initial investment. 7. Debt service coverage ratio (DSCR). This ratio measures the ability of a property to cover its debt obligations by comparing the property's net operating income to its debt service payments. These methods can be used individually or in combination to provide investors with a comprehensive understanding of their real estate investment performance. It is important to note that each method has its own limitations and may not provide a complete picture of the investment's performance. Investors should use multiple methods to evaluate their investment performance and make informed decisions. Real estate investment portfolio rebalancing. Real estate investment portfolio rebalancing is a process of adjusting the composition of an investor's real estate portfolio by buying and selling properties to bring it back in line with their investment goals and risk tolerance. The goal of rebalancing is to maintain a portfolio that meets the investor's long-term objectives while minimizing risk. The process of rebalancing a real estate portfolio typically involves two steps: assessing the current portfolio and adjusting the portfolio accordingly. Assessing the current portfolio involves evaluating the current composition of the portfolio, including property types, location, and investment performance. This assessment helps identify any areas where the portfolio is over or underrepresented and may require adjustment. The investor should also assess their investment goals and risk tolerance to ensure the portfolio aligns with their objectives. Adjusting the portfolio involves buying or selling properties to bring the portfolio back in line with the investor's objectives. If the portfolio is overweight in certain property types or locations, the investor may sell some of these properties and invest in other areas. Conversely, if the portfolio is underrepresented in certain areas, the investor may buy properties in those locations. There are several factors to consider when rebalancing a real estate investment portfolio. These include the investor's investment goals, risk tolerance, the current state of the real estate market, and the performance of the portfolio. It is important to rebalance a portfolio periodically, usually once or twice a year, to ensure it stays aligned with the investor's goals and risk tolerance. One potential challenge of portfolio rebalancing is the transaction costs associated with buying and selling properties. These costs can include real estate agent fees, closing costs, and taxes. It is important to factor in these costs when considering rebalancing a portfolio to ensure the benefits outweigh the costs. In conclusion, real estate investment portfolio rebalancing is an essential process for any real estate investor. By assessing the current portfolio and adjusting it accordingly, investors can ensure their investments are aligned with their long-term goals and risk tolerance. While there may be costs associated with rebalancing, the benefits can be significant, including lower risk and improved performance. Real estate investment portfolio optimization. Real estate investment portfolio optimization involves developing a strategy to maximize the return on investment (ROI) while minimizing risk in a real estate investment portfolio. It is a process of selecting the best combination of properties that will generate the highest return on investment with the lowest possible risk. To optimize a real estate investment portfolio, there are several steps that investors should consider. 1. Define investment goals and objectives. Before beginning the optimization process, it is essential to have clear investment goals and objectives. This includes determining the target ROI, the desired level of risk, and the investment horizon. 2. Conduct market research. Real estate investors must conduct thorough market research to identify the best investment opportunities. This includes analyzing market trends, demographics, economic indicators, and supply and demand factors. 3. Evaluate properties. The next step is to evaluate the properties that fit the investment goals and objectives. The evaluation process should include analyzing the financial performance, potential for appreciation, tenant profiles, and maintenance costs. 4. Portfolio diversification. It is crucial to diversify the portfolio by investing in a variety of properties, such as commercial, residential, industrial, and retail properties. Diversification helps to minimize risk and maximize ROI. 5. Risk management. To manage risk, investors must identify potential risks and develop strategies to mitigate them. For example, investing in properties with long-term leases reduces the risk of vacancy, while investing in areas with strong economic growth potential can help minimize the risk of a decline in property values. 6. Portfolio monitoring and rebalancing. Once the portfolio is established, it is important to regularly monitor and rebalance it. This involves reviewing the performance of each property and adjusting the portfolio as necessary to optimize returns and minimize risk. 7. Real estate investors can also use various optimization tools and techniques, such as the modern portfolio theory (MPT) and Monte Carlo simulation, to optimize their portfolios. MPT is a widely used investment theory that seeks to maximize returns by balancing risk and reward, while Monte Carlo simulation uses statistical modeling to forecast the performance of a portfolio under various scenarios. In conclusion, real estate investment portfolio optimization is a crucial aspect of real estate investment that involves selecting the right mix of properties to maximize ROI and minimize risk. By following the steps outlined above, investors can develop a sound investment strategy that aligns with the goals and objectives. Real estate investment return on investment (ROI). Real estate investment return on investment (ROI) refers to the measurement of the profitability of a real estate investment. ROI is a crucial metric for investors as it helps them to determine the effectiveness of their investment strategy and make informed decisions about future investments. There are several methods used to calculate ROI in real estate investments, and these include 1. Cash-on-cash return. This method calculates the amount of cash generated from an investment as a percentage of the initial investment. This is calculated by dividing the annual cash flow by the initial investment. 2. Capitalization rate (cap rate). This method determines the potential return on investment by dividing the net operating income (NOI) by the current market value of the property. This method is useful in comparing the return on investment between properties with different values. 3. Gross rent multiplier (GRM). This method measures the number of years it will take to recoup the investment in a property through rental income. It is calculated by dividing the purchase price of a property by the gross annual rental income. 4. Internal rate of return (IRR). This method considers the time value of money and calculates the annualized rate of return over a period of time. It takes into account the initial investment, cash flows, and the timing of those cash flows. Investors use these methods to evaluate the performance of their real estate investments and determine which investment opportunities offer the highest return on investment. A higher ROI indicates a more profitable investment, while a lower ROI suggests a less profitable investment. However, it is important to note that ROI should not be the sole factor considered when making real estate investment decisions. Other factors such as market conditions, location, property type, and financing options should also be considered to make a well-informed investment decision. Real estate investment internal rate of return (IRR). The internal rate of return (IRR) is a popular financial metric used to evaluate real estate investment opportunities. It is a calculation that takes into account the time value of money, and it measures the profitability of an investment over time. The IRR is the discount rate at which the present value of the investment's future cash flows equals the initial investment. In other words, it is the interest rate that makes the net present value of the investment's cash flows equal to zero. A higher IRR indicates a more profitable investment. To calculate the IRR of a real estate investment, an investor would need to estimate the property's future cash flows, which include rental income, operating expenses, and capital expenditures, as well as the timing of those cash flows. These cash flows are then discounted back to the present value using the IRR. One benefit of using the IRR is that it considers the time value of money, meaning that $1 today is worth more than $1 tomorrow. By accounting for this, the IRR allows investors to evaluate the profitability of an investment over time, rather than just at a single point in time. Another benefit of using the IRR is that it allows investors to compare the profitability of different investment opportunities. For example, if an investor is considering two different real estate investments, they can use the IRR to determine which investment is more profitable. However, there are also some limitations to using the IRR. One limitation is that it assumes that all cash flows are reinvested at the same rate as the IRR, which may not always be the case. Additionally, the IRR may not be a reliable metric for investments with irregular cash flows or investments with long time horizons. Overall, the IRR is a useful metric for evaluating the profitability of real estate investments, but it should be used in conjunction with other financial metrics and should be interpreted carefully to account for its limitations. Real estate investment net present value (NPV). Net present value (NPV) is a commonly used financial metric in real estate investment analysis. It measures the value of an investment project by comparing the present value of its expected cash flows to the initial investment cost. The NPV calculation takes into account the time value of money, which means that future cash flows are discounted back to the present value using a discount rate. In the context of real estate investment, the NPV calculation can be used to evaluate the profitability of a property investment project. The expected cash flows include the rental income, capital appreciation, and any proceeds from the sale of the property at the end of the investment period. The initial investment cost includes the purchase price, closing costs, and any renovation or improvement costs. To calculate the NPV of a real estate investment project, the expected cash flows are estimated over the investment period and discounted back to the present value using a discount rate that reflects the opportunity cost of capital. The discount rate is typically based on the cost of capital for the real estate market, which includes factors such as inflation, interest rates, and risk. If the NPV is positive, it means that the investment project is expected to generate more cash inflows than outflows, and therefore it is considered a profitable investment. Conversely, if the NPV is negative, it means that the investment project is expected to generate more cash outflows than inflows, and therefore it is considered a loss-making investment. The NPV calculation is an important tool for real estate investors to assess the profitability of their investment projects and to compare the expected returns of different investment options. It helps investors to make informed investment decisions and to allocate their resources efficiently to achieve their investment objectives. However, it is important to note that the accuracy of the NPV calculation depends on the quality of the underlying assumptions and estimates, which are subject to various risks and uncertainties. Real estate investment cash-on-cash return. Real estate investment cash-on-cash return is a performance measure used to evaluate the profitability of a real estate investment by comparing the cash inflows to the amount of cash invested. It is calculated by dividing the annual net cash flow by the total cash invested, expressed as a percentage. The cash-on-cash return is a popular metric for real estate investors because it provides an accurate measure of the return on their investment, taking into account the amount of cash they have invested. It is a useful tool for evaluating potential investment opportunities, as well as for monitoring the performance of existing investments. The calculation of the cash-on-cash return begins with the determination of the net cash flow, which is the difference between the gross rental income and the operating expenses of the property. The net cash flow is then divided by the total cash invested in the property, which includes the down payment, closing costs, and any other expenses related to the acquisition of the property. For example, if an investor purchases a property for $500,000 with a down payment of $100,000 and incurs $20,000 in closing costs, the total cash invested would be $120,000. If the property generates an annual net cash flow of $12,000, the cash-on-cash return would be calculated as follows. Cash-on-cash return equals annual net cash flow, total cash invested. Cash-on-cash return equals $12,000 per $120,000. Cash-on-cash return equals 10%. This means that the investor's cash investment is generating a 10% return on an annual basis. One of the benefits of the cash-on-cash return calculation is that it provides a more accurate measure of the actual return on investment than other measures, such as the overall rate of return. This is because the cash-on-cash return takes into account the amount of cash invested, rather than the total value of the investment, which can be affected by factors such as changes in property values. In addition to helping investors evaluate potential investments, the cash-on-cash return is also a useful tool for monitoring the performance of existing investments. By regularly calculating the cash-on-cash return of a property, investors can assess whether the investment is meeting their expected returns, and make any necessary adjustments to their investment strategy. Overall, the cash-on-cash return is a valuable metric for real estate investors, providing an accurate measure of the return on their investment and helping them to make informed investment decisions. Real estate investment capitalization rate (cap rate). Real estate investment capitalization rate (cap rate) is a metric that is commonly used in real estate investment analysis to determine the potential return on investment (ROI) of a property. The cap rate is the ratio of the property's net operating income (NOI) to its purchase price or value. It is expressed as a percentage, with a higher cap rate indicating a higher potential return on investment. The formula for calculating the cap rate is cap rate equals NOI property value, where NOI is the net operating income, which is calculated by subtracting operating expenses from the property's gross income. Operating expenses may include property taxes, insurance, maintenance costs, utilities, and management fees. The cap rate is a useful tool for investors to compare the potential return on investment of different properties. A higher cap rate may indicate a property that is undervalued or has higher income potential, while a lower cap rate may indicate a property that is overvalued or has lower income potential. However, it is important to note that the cap rate does not take into account other factors that may affect the return on investment, such as financing costs, taxes, and potential future appreciation or depreciation of the property. Real estate investors should also be aware that the cap rate can vary depending on the type of property and location. For example, commercial properties typically have a higher cap rate than residential properties due to the higher risk associated with commercial properties. In addition, properties located in areas with high demand and limited supply may have a lower cap rate due to the higher property values. In summary, the cap rate is an important metric for real estate investors to consider when evaluating potential investment properties. It can help investors compare the potential return on investment of different properties and identify properties that may be undervalued or have higher income potential. However, it should be used in conjunction with other investment analysis tools and should not be the sole factor in making investment decisions. Real Estate Investment Debt Coverage Ratio, DCER. Real Estate Investment Debt Coverage Ratio, DCER, is a financial ratio used to evaluate the ability of a real estate investment to generate sufficient cash flow to cover its debt service obligations. The DCER compares the net operating income (NOI) of the property to its debt service, which includes the principal and interest payments on its mortgage. The formula for calculating DCER is DCER equals NOI debt service, where NOI is the net operating income of the property and debt service is the total amount of debt service due on the property. A DCER of 1 indicates that the property's net operating income is equal to its debt service, meaning that it generates just enough income to cover its mortgage payments. A DCER of less than 1 means that the property's net operating income is insufficient to cover its debt service, indicating a higher risk of default. A DCER of greater than 1 indicates that the property generates more income than it needs to cover its debt service, which is generally considered a positive sign of financial health. The DCER is an important metric for lenders when evaluating a real estate investment's ability to service its debt obligations. Lenders typically require a minimum DCER of 1.2 to 1.3, depending on the type of property and its location. A higher DCER may make the property more attractive to lenders, as it indicates a lower risk of default. Investors also use the DCER to evaluate the financial performance of a real estate investment. A low DCER may indicate that the property is not generating enough income to cover its expenses and debt service, and may require additional capital to make it profitable. On the other hand, a high DCER may indicate that the property is generating excess cash flow, which could be reinvested into the property or distributed to investors as dividends. In summary, the debt coverage ratio is an important metric used to evaluate the financial performance of a real estate investment. It provides a measure of the property's ability to generate sufficient income to cover its debt service obligations and is used by lenders and investors to assess the risk and potential return of the investment. Real Estate Investment Debt Service Coverage Ratio, DSCR. Debt Service Coverage Ratio, DSCR, is a financial metric used in real estate investment analysis to assess the ability of a property to cover its debt payments. DSCR is calculated by dividing the property's net operating income (NOI) by its total debt service. The resulting ratio indicates the property's ability to generate sufficient cash flow to cover its debt obligations. In general, a higher DSCR is considered more favorable, as it suggests the property has a stronger ability to meet its debt obligations. The ideal DSCR varies depending on the lender and the type of property, but most lenders prefer a DSCR of at least 1.21. This means that the property generates at least 20% more cash flow than it needs to make its debt payments. To calculate the DSCR, one needs to first determine the net operating income (NOI) of the property. The NOI is the income generated by the property minus its operating expenses, but before any debt service payments. Once the NOI is determined, the total debt service payments are calculated by adding up all the principal and interest payments on the property's debt. For example, let's say a property generates $150,000 in NOI and has $100,000 in total debt service payments for the year. The DSCR would be calculated as follows. DSCR equals NOI total debt service. DSCR equals $150,000 per $100,000. DSCR equals 1.5. In this example, the property has a DSCR of 1.5, which is considered strong. The DSCR is an important metric for real estate investors to consider when analyzing potential investment opportunities. It helps to determine whether a property has the cash flow necessary to meet its debt obligations and avoid default. Lenders also use the DSCR when evaluating loan applications, as it helps them assess the risk of lending to a particular property. In addition to the DSCR, investors may also consider other metrics such as the debt coverage ratio, DCR, which is similar to the DSCR but focuses on the property's ability to cover its mortgage payments only. The DCR is calculated by dividing the property's net operating income by its mortgage payment. The higher the DCR, the better the property's ability to cover its mortgage payments. Real estate investment equity multiple. Real estate investment equity multiple is a financial metric used to evaluate the profitability of a real estate investment. It measures the total return on investment relative to the amount of equity invested. The equity multiple is expressed as a ratio, typically greater than 1, with a higher ratio indicating a more profitable investment. To calculate the equity multiple, you need to first determine the total cash inflows and outflows associated with the investment over its entire holding period. This includes rental income, sale proceeds, and any other cash flows related to the investment, as well as any associated expenses, such as property management fees, maintenance costs, and taxes. Once you have calculated the total cash inflows and outflows, subtract the total equity invested from the total cash inflows to determine the profit earned on the investment. Divide the profit earned by the total equity invested to calculate the equity multiple. For example, let's say you invested $100,000 in a real estate property and received total cash inflows of $150,000 over a 5-year holding period. After accounting for expenses, your total profit on the investment is $40,000. To calculate the equity multiple, divide the profit earned by the total equity invested, $40,000 per $100,000 equals 1.4. This means that for every $1 of equity invested, you earned $1.40 in total returns. The equity multiple is a useful tool for evaluating real estate investments because it provides a simple way to compare the profitability of different investments with varying holding periods and cash flows. It also takes into account the impact of leverage, which can amplify returns but also increase risk. However, it is important to note that the equity multiple does not take into account the time value of money, which can be a significant factor in long-term investments. Additionally, it does not account for differences in risk or the impact of taxes on investment returns. Therefore, it should be used in conjunction with other metrics and analysis to make informed investment decisions. Real estate investment loan-to-value ratio (LTV). Real estate investment loan-to-value ratio (LTV) is a financial metric used to assess the risk and return of a real estate investment. It is the ratio of the mortgage loan amount to the appraised value or purchase price of the property. The LTV ratio is an important factor that lenders use to determine the maximum amount of loan that they are willing to extend to a borrower. The LTV ratio is expressed as a percentage, and it is calculated by dividing the loan amount by the appraised value or purchase price of the property. For example, if the purchase price of a property is $500,000 and the mortgage loan amount is $400,000, the LTV ratio would be 80%, $400,000 divided by $500,000 by 100%. The LTV ratio is a critical factor in determining the risk level of a real estate investment. A high LTV ratio means that the borrower has a smaller equity stake in the property, which makes the investment riskier for the lender. A low LTV ratio, on the other hand, indicates that the borrower has a larger equity stake in the property and is less risky for the lender. Investors also use the LTV ratio to assess the risk and potential return of a real estate investment. A higher LTV ratio can mean a higher potential return on investment, as the investor is using less of their own capital and has the opportunity to leverage the investment with borrowed funds. However, a higher LTV ratio also means a higher risk of default if the property value decreases or if the rental income does not cover the mortgage payments. In addition to the LTV ratio, lenders may also consider other factors such as the borrower's credit score, income, and debt-to-income ratio when making a lending decision. Investors should also consider the LTV ratio in conjunction with other financial metrics such as cash-on-cash return, cap rate, and debt coverage ratios to make informed investment decisions. Real estate investment debt-to-equity ratio (DE). Real estate investment debt-to-equity ratio (DE) is a financial metric used to assess the amount of debt versus equity used to finance a real estate investment. It is calculated by dividing the total amount of debt used to finance the investment by the total amount of equity. The debt-equity ratio is a crucial measure for real estate investors as it helps to determine the level of financial leverage used in the investment. Financial leverage refers to the use of borrowed funds to increase the potential return on investment. It allows investors to control more assets with less capital, which can magnify potential profits but also increases the risk of losses. The debt-equity ratio indicates how much debt the investor has taken on relative to equity in the property. A high debt-equity ratio indicates that a significant portion of the investment has been financed with debt, while a low debt-equity ratio indicates a lower level of leverage and a higher level of equity. Investors use this ratio to evaluate the risk and return of the investment and to make informed decisions on how much leverage to use in a given investment. In general, a higher debt-equity ratio implies higher risk, as more debt means a greater financial burden for the investor, especially if the property does not generate enough income to service the debt. On the other hand, a lower debt-equity ratio means that the investor has more equity in the property and is less dependent on borrowed funds to finance the investment. A debt-equity ratio of 1:1 indicates that the investment is equally financed by debt and equity, while a debt-equity ratio of 2:1 implies that the investment is twice as leveraged as it is equity funded. A debt-equity ratio of less than 1 indicates that the investment is primarily funded by equity. Real estate investors often set a target debt-equity ratio based on their risk tolerance and investment goals. For example, conservative investors may aim for a low debt-equity ratio to minimize risk, while more aggressive investors may aim for a higher debt-equity ratio to maximize potential returns. In conclusion, the debt-to-equity ratio is an essential measure in real estate investment analysis that allows investors to evaluate the level of financial leverage used in the investment. A higher debt-equity ratio implies higher risk, while a lower debt-equity ratio indicates a lower level of leverage and a higher level of equity. Investors should use this ratio to make informed decisions on how much leverage to use in a given investment, based on their risk tolerance and investment goals. Real estate investment gross rent multiplier, GRM. Real estate investment requires careful consideration of various financial metrics to evaluate the performance and potential return of a property. One such metric is the gross rent multiplier, GRM, which is a ratio used to assess the property's value relative to its gross rental income. The GRM is calculated by dividing the property's sale price by its gross annual rental income. For example, if a property is listed for $500,000 and generates $60,000 per year in rental income, the GRM would be 8.3. $500,000 divided by $60,000 equals 8.3. This means that it would take 8.3 years of rental income to recoup the initial investment. The GRM can be a useful tool for real estate investors because it provides a quick and simple way to compare properties in terms of their value and income potential. However, it is important to note that the GRM does not take into account expenses such as taxes, insurance, maintenance, and vacancies, which can significantly impact the property's profitability. Additionally, the GRM may not accurately reflect the property's income potential if the rental income varies significantly from year to year or if there are significant differences in the operating expenses of comparable properties. As such, it is important for investors to use the GRM in conjunction with other financial metrics, such as net operating income, NOI, cash flow, and cap rate, to make informed investment decisions. By analyzing a variety of financial metrics, investors can gain a comprehensive understanding of a property's performance and potential return, and make investment decisions that align with their financial goals and risk tolerance. Real estate investment net operating income (NOI). Real estate investment net operating income (NOI) is a key performance metric that helps real estate investors determine the profitability of a property. It is calculated by subtracting operating expenses from the property's gross rental income. Gross rental income is the total amount of money generated from renting out the property, while operating expenses include all costs associated with running the property, such as property taxes, insurance, utilities, repairs, and maintenance. The formula for calculating NOI is NOI equals gross rental income, operating expenses. NOI is important because it helps real estate investors assess the profitability of a property without taking into account the financing costs or the owner's personal income tax situation. In other words, NOI provides a clear picture of the property's ability to generate income before considering any mortgage payments, taxes, or other expenses related to the owner's personal financial situation. NOI is also a useful metric for comparing different properties or evaluating the performance of a property over time. For example, if an investor is considering two different properties, they can use NOI to determine which property is more profitable. They can also use NOI to track the performance of a property over time, identify trends, and make informed decisions about whether to hold or sell the property. In addition to being used to evaluate individual properties, NOI is also used to calculate other important financial ratios such as the capitalization rate, cap rate, and the cash-on-cash return. Cap rate is calculated by dividing the property's NOI by its market value, while cash-on-cash return is calculated by dividing the property's NOI by the amount of cash invested in the property. Overall, net operating income is a critical metric for real estate investors and plays an important role in evaluating the financial performance of a property. Real estate investment vacancy rate. Real estate investment vacancy rate is a key metric used to measure the occupancy level of a rental property. It is the percentage of units in a rental property that are vacant and available for rent. This metric is used by investors to assess the potential rental income of a property, as well as its overall profitability. Calculating the vacancy rate is relatively simple. You take the number of vacant units and divide it by the total number of units in the property. For example, if a rental property has 20 units and 2 are currently vacant, the vacancy rate would be 10%, 2/20. Investors use the vacancy rate to make informed decisions about their rental properties. A high vacancy rate can indicate that the property is not attracting tenants or that tenants are leaving due to issues with the property or management. A low vacancy rate, on the other hand, is a positive sign that the property is in high demand and generating steady rental income. A vacancy rate that is too high can lead to a decrease in cash flow, as the investor is not generating as much rental income as they could be. Additionally, a high vacancy rate can be an indication that the investor needs to adjust their marketing or pricing strategy, or that there may be issues with the property that need to be addressed. Conversely, a low vacancy rate can be a sign that the property is in high demand, and that rental prices could potentially be increased. However, it's important for investors to balance the need for high occupancy with the need for quality tenants. Accepting any tenant just to fill a vacancy can lead to issues with non-payment of rent or damage to the property. Overall, the vacancy rate is an important metric that investors use to gauge the health and profitability of their rental properties. By monitoring this metric and taking steps to adjust strategies as needed, investors can maximize their rental income and ensure the long-term success of their investments. Real estate investment appreciation. Real estate investment appreciation refers to the increase in the value of a property over time. This appreciation can come from a variety of factors, such as improvements made to the property, increased demand in the area, or general economic growth. It is an important consideration for real estate investors, as it can have a significant impact on their returns. There are several factors that can influence real estate investment appreciation. 1. Location. The old adage in real estate is location, 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 and for good reason. Properties in desirable locations, such as near schools, parks, or transportation hubs, are more likely to appreciate in value than those in less desirable areas. 2. Market conditions. The overall health of the real estate market can impact the appreciation of a property. In a strong market with high demand, properties may appreciate quickly, while in a weak market with low demand, appreciation may be slower. 3. Condition of the property. A well-maintained property is more likely to appreciate in value than one that is in poor condition. Renovations and improvements can also increase a property's value. 4. Interest rates. Changes in interest rates can impact the affordability of real estate purchases, which can in turn impact demand and property values. 5. Economic growth. Economic growth can lead to increased demand for real estate, which can drive up property values. There are also different types of appreciation that can impact real estate investments. 1. Forced appreciation. This type of appreciation comes from improvements made to a property by the investor. For example, adding a new bathroom or renovating a kitchen can increase a property's value. 2. Natural appreciation. This type of appreciation comes from market factors outside of the investor's control, such as general economic growth or increased demand in the area. Real estate investors can use appreciation to their advantage by holding onto properties for a long period of time, allowing them to benefit from the increase in value over time. However, it's important to note that appreciation is not guaranteed, and there is always a risk that a property's value could decline instead. As such, it's important for investors to carefully evaluate market conditions and consider all potential risks before making an investment. Real estate investment depreciation. Real estate investment depreciation refers to the decrease in value of a property over time due to wear and tear, age, and other factors. It is one of the most important factors that investors need to consider when analyzing the potential profitability of a real estate investment. Depreciation is a non-cash expense that is recognized for accounting purposes. In other words, it is not an actual cash outflow, but rather a reduction in the value of an asset that is accounted for on a company's income statement. Depreciation allows investors to spread the cost of a property over its useful life, which helps to offset the income generated by the property. There are two methods used to calculate depreciation for real estate investment purposes: straight-line depreciation and accelerated depreciation. Straight-line depreciation is the simplest and most common method used to calculate depreciation. It involves dividing the cost of the property by its useful life and then deducting the resulting amount from the property's value each year. For example, if a property is purchased for $500,000 and has a useful life of 27.5 years, the annual depreciation expense would be approximately $18,182, $500,000 divided by 27.5. Accelerated depreciation, on the other hand, allows investors to take larger depreciation deductions in the earlier years of ownership. This method is often used by real estate investors to reduce the tax liabilities. One common method of accelerated depreciation is the Modified Accelerated Cost Recovery System (MACRS), which allows investors to take larger deductions in the first few years of ownership and then gradually decrease the deduction over time. While depreciation is an important factor to consider when analyzing the potential profitability of a real estate investment, it is not the only factor. Other factors that investors need to consider include rental income, vacancy rates, property taxes, maintenance costs, and financing costs. In addition, it's important to note that while depreciation can reduce an investor's taxable income, it can also impact the investor's basis in the property, which can impact the investor's taxes when the property is sold. For this reason, it's important for real estate investors to work with a qualified tax professional to ensure they are maximizing the benefits of depreciation while minimizing the tax liabilities. Real estate investment leverage. Real estate investment leverage refers to the use of borrowed funds to purchase real estate assets. Leverage allows investors to increase the purchasing power and acquire more properties than they would be able to with their own cash reserves alone. This can potentially increase their returns on investment, but it also comes with increased risk. One of the primary benefits of using leverage in real estate investing is the ability to increase potential returns. By using borrowed funds, investors can acquire more properties or larger properties that generate higher rental income, which can lead to higher cash flow and appreciation over time. Additionally, leverage can allow investors to take advantage of low interest rates, which can increase the cash-on-cash return on investment. However, leverage also increases the risk of investing in real estate. If the market experiences a downturn or property values decrease, investors can be left with negative equity, or the property may not generate enough rental income to cover the debt service. This can lead to defaulting on loans and potentially losing the property. There are different types of leverage that investors can use in real estate investing. One common type is mortgage leverage, which involves borrowing money from a bank or lender to purchase a property. The loan is secured by the property and the lender typically requires a down payment from the borrower. Another type of leverage is equity leverage, which involves using equity in one property to finance the purchase of another property. This can be done through a cash-out refinance, where an investor refinances an existing property and takes out cash to purchase another property, or through a home equity line of credit (HELOC). When using leverage in real estate investing, it is important for investors to consider their risk tolerance and the potential returns. Investors should also consider the terms and interest rates of the loans they are taking out, as well as the potential for market fluctuations and changes in property values. It is important to have a solid understanding of leverage and its potential benefits and risks before making investment decisions. Real estate investment tax benefits. Real estate investment can provide a variety of tax benefits that can help investors increase their returns and reduce the tax liability. Here are some of the main tax benefits of real estate investment. 1. Depreciation. Real estate investors can claim depreciation on the properties as a tax deduction. Depreciation is a non-cash expense that reflects the wear and tear of the property over time, and can be claimed annually over the useful life of the property. This reduces taxable income and results in lower tax liability. 2. Capital gains. When a real estate investor sells a property for more than the original purchase price, they realize a capital gain. The tax rate on capital gains depends on the investor's income and the length of time they held the property. Investors who hold the property for more than a year are eligible for lower long-term capital gains tax rates. 3. 1031 exchange. A 1031 exchange allows real estate investors to defer paying capital gains taxes when they sell one property and buy another similar property. By using this strategy, investors can continuously defer taxes as they buy and sell properties, allowing them to build wealth more efficiently. 4. Deductible expenses. Real estate investors can deduct various expenses associated with their investment properties, including property taxes, mortgage interest, insurance premiums, repairs, and maintenance costs. These expenses reduce taxable income and help investors reduce the tax liability. 5. Passive losses. Real estate investors can use passive losses to offset other sources of income. Passive losses occur when rental income does not cover the expenses associated with the property, resulting in a net loss. This loss can be used to offset other forms of income, reducing the investor's tax liability. It is important to note that real estate tax laws are complex and constantly changing. It is recommended that real estate investors work with a tax professional to ensure they are maximizing the tax benefits while remaining compliant with all relevant tax laws and regulations. Real estate investment passive income. Real estate investment can be a great way to generate passive income. Passive income is defined as money earned without actively working for it. In the context of real estate investment, passive income refers to the cash flow generated by rental properties, which require relatively little ongoing effort from the investor. One of the benefits of investing in rental properties is the potential to generate passive income in the form of rental income. The rent paid by tenants provides a steady stream of cash flow that can be used to cover expenses, pay down debt, or reinvest in additional properties. To generate passive income from rental properties, it's important to carefully select properties in areas with strong rental demand and to set rents at a level that is competitive with other properties in the area. It's also important to keep expenses low by maintaining the property, collecting rent on time, and carefully screening tenants to reduce the risk of missed rent payments or property damage. Another way to generate passive income through real estate investment is through real estate crowdfunding. Crowdfunding platforms allow individual investors to pool their resources and invest in larger real estate projects, such as apartment complexes or commercial properties. In exchange for their investment, investors receive a share of the rental income generated by the property, as well as a share of any profits generated when the property is sold. Passive income from real estate investment can also be generated through real estate investment trusts, IEITs. IEITs are companies that own and operate income-producing real estate properties, such as shopping malls, office buildings, and apartment complexes. Investors can purchase shares in a IEIT and receive a share of the rental income generated by the properties owned by the trust. In conclusion, real estate investment can be a great way to generate passive income. Whether through rental properties, real estate crowdfunding, or IEITs, investors have a variety of options for generating passive income through real estate investment. However, it's important to carefully research and evaluate potential investment opportunities to ensure that they are a good fit for your financial goals and risk tolerance. Real estate investment active income. Real estate investment can generate both passive and active income streams. Passive income refers to income that is earned without direct involvement in the day-to-day management of the property. Active income, on the other hand, involves actively managing the property, such as collecting rent, handling maintenance issues, and marketing the property to potential tenants or buyers. Passive income is a major draw for many real estate investors. This can come from various sources, such as rental income, leasing land, or investing in real estate investment trusts, IEITs. Rental income is one of the most common forms of passive income in real estate investment. Investors can purchase a property, rent it out to tenants, and collect monthly rent payments. The amount of passive income generated by rental income depends on factors such as the location, demand, and rent prices of the property. In contrast, active income in real estate investment involves more hands-on work. Investors who want to generate active income may choose to flip properties or engage in property management services for other investors. Flipping properties involves buying a property, fixing it up, and selling it for a profit. This process can involve significant work and requires a good understanding of the local real estate market, renovation costs, and property values. Another way to generate active income in real estate is by offering property management services to other investors. Property management services involve handling the day-to-day operations of a property, such as maintenance, rent collection, and tenant management. Property managers may earn a percentage of the rental income as the fee for managing the property. In summary, real estate investment offers both passive and active income opportunities. Passive income can come from rental income, leasing land, or investing in REITs, while active income may be generated through flipping properties or offering property management services. The type of income stream that is most suitable for an investor depends on their investment goals and level of involvement in the investment process. Real estate investment negative cash flow. Real estate investment negative cash flow occurs when the expenses of a property exceed the income it generates. In other words, the property is not generating enough rental income to cover its operating expenses, such as mortgage payments, property taxes, insurance, maintenance, and repairs. This results in a net loss for the investor, which can be a significant financial burden. Negative cash flow is common in the early stages of real estate investment when a property is being developed or renovated. During this time, there may be high expenses related to construction, property management, and marketing, and the property may not be fully leased or generating sufficient rental income. In some cases, negative cash flow may also occur due to unexpected repairs or vacancies. Negative cash flow can be a serious problem for real estate investors, especially if they have to cover the expenses out of their own pockets. However, there are some strategies that investors can use to mitigate the negative effects of negative cash flow. These include 1. Reduce expenses. One way to reduce negative cash flow is to reduce expenses. This can be done by finding ways to lower property management, maintenance, and repair costs, or by negotiating lower interest rates on mortgages. 2. Increase rental income. Investors can also increase the rental income of the properties by increasing occupancy rates or raising rents. This can be done by improving the property's condition, offering incentives to tenants, or targeting higher paying tenants. 3. Refinance. Refinancing a mortgage can also help reduce negative cash flow. This can be done by negotiating a lower interest rate, extending the loan term, or adjusting the payment schedule. 4. Sell the property. In some cases, it may be necessary to sell the property to avoid further losses. This can be done by finding a buyer who is willing to pay a fair price for the property or by using creative financing techniques, such as seller financing or lease options. 5. Seek professional advice. Finally, investors can seek professional advice from real estate experts, such as property managers, accountants, or financial advisors. These professionals can provide valuable insights into how to reduce expenses, increase rental income, and make smart investment decisions. In summary, negative cash flow is a common problem in real estate investment, but it can be managed with the right strategies and advice. By reducing expenses, increasing rental income, refinancing, selling the property, or seeking professional advice, investors can minimize the impact of negative cash flow on their investment portfolio. Real estate investment passive losses. Real estate investment passive losses refer to the losses incurred from an investment in real estate that cannot be used to offset other sources of income. These losses can arise due to a variety of reasons, including property depreciation, mortgage interest payments, and property management fees. Passive losses are different from active losses, which refer to losses incurred from a business activity in which the investor actively participates. Passive losses, on the other hand, are incurred from activities in which the investor does not actively participate, such as rental properties or real estate investment trusts, REITs. One of the main advantages of passive losses is their ability to reduce an investor's taxable income. In most cases, the passive losses can be deducted against the investor's passive income, which includes income from rental properties, royalties, and other sources. However, if the passive losses exceed the passive income, the excess losses cannot be deducted in the current tax year. Instead, the losses can be carried forward to future tax years to offset any future passive income or to offset capital gains when the property is sold. It is important to note that the IRS has specific rules regarding passive losses, and investors should consult with a tax professional to ensure compliance with these rules. In addition, certain real estate investments, such as those made through a limited partnership, may have additional restrictions on the ability to deduct passive losses. In summary, real estate investment passive losses can provide a tax benefit to investors, but they must be used in accordance with IRS regulations. It is important for investors to understand the rules governing passive losses and to work with a qualified tax professional to ensure compliance. Real estate investment active losses. Real estate investment, like any other investment, can be affected by both gains and losses. When it comes to losses, they can be classified into two categories, passive and active losses. Passive losses refer to losses incurred by real estate investors who are not actively involved in the management of the property. These losses are usually the result of depreciation deductions exceeding the property's income. For example, if an investor has a rental property that generates $10,000 in income but has $15,000 in depreciation deductions, they will have a $5,000 passive loss. Active losses, on the other hand, are incurred by real estate investors who are actively involved in the management of the property. These losses can be the result of expenses such as repairs and maintenance or mortgage interest payments exceeding the income generated by the property. In both cases, losses can be used to offset gains in other areas of an investor's portfolio. For example, passive losses can be used to offset gains in other passive investments, while active losses can be used to offset gains in active investments. Additionally, losses can be carried forward to future years to offset gains in those years. It's important to note that there are limitations to the amount of losses that can be deducted from an investor's taxable income. For passive losses, there are restrictions on the amount that can be deducted based on an investor's income level. Active losses, on the other hand, are generally not subject to these restrictions. In conclusion, real estate investment can result in both gains and losses. Passive and active losses are two types of losses that can be incurred by real estate investors, and they can be used to offset gains in other areas of an investor's portfolio. It's important to understand the limitations on the amount of losses that can be deducted from taxable income and to seek the advice of a tax professional when necessary. Real estate investment tax credits. Real estate investment tax credits are incentives provided by the government to encourage investment in certain types of real estate. These credits are designed to offset the cost of the investment and provide a financial incentive for investors to invest in specific areas or types of properties. Tax credits can be a powerful tool for investors looking to maximize their return on investment, reduce the tax liability, and support community development. There are several types of real estate investment tax credits that investors can take advantage of. 1. Historic Rehabilitation Tax Credit. This credit is available to investors who restore and rehabilitate historic buildings that are listed on the National Register of Historic Places. The credit provides a 20% tax credit for the qualified rehabilitation expenses of certified historic structures. 2. Low-Income Housing Tax Credit. This credit is designed to encourage the development of affordable housing. It is available to investors who develop and maintain rental housing for low-income households. The credit is calculated based on the cost of constructing the building and is spread over a 10-year period. 3. New Markets Tax Credit. This credit is designed to encourage investment in economically distressed areas. It provides a credit for investments made in designated community development entities, CDEs. The credit is calculated based on the amount of the investment and is spread over a 7-year period. 4. Renewable Energy Tax Credit. This credit is available to investors who invest in renewable energy projects, such as solar, wind, and geothermal. The credit is calculated based on the cost of the project and is spread over a 5-year period. 5. Opportunity Zone Tax Credit. This credit is designed to encourage investment in economically distressed areas known as opportunity zones. It provides a tax incentive for investors who invest in qualified opportunity funds, which invest in businesses and real estate projects located in these areas. Investors should carefully consider the potential benefits and risks associated with real estate investment tax credits. While these credits can provide a significant financial benefit, they often come with strict eligibility requirements and complex regulations. It is important to consult with a qualified tax professional before making any investment decisions based on real estate investment tax credits. Real estate investment tax deductions. Real estate investment tax deductions refer to the various expenses related to owning, operating, and maintaining a rental property that can be deducted from taxable income. These deductions help investors reduce the tax liability and increase their net rental income. In this response, we will discuss some of the most common real estate investment tax deductions. 1. Mortgage interest. One of the most significant deductions for real estate investors is mortgage interest. Investors can deduct the interest paid on their mortgage for the rental property, which can significantly reduce the taxable income. 2. Property taxes. Another significant deduction for real estate investors is property taxes. Property taxes are a recurring expense that can add up quickly, but they are fully tax deductible. 3. Depreciation. Depreciation is the loss of value over time due to wear and tear, age, or obsolescence. Real estate investors can claim depreciation as a deduction on the taxes. This deduction allows investors to recover the cost of their investment property over a set period, typically 27.5 years for residential properties and 39 years for commercial properties. 4. Repairs and maintenance. Expenses related to repairs and maintenance of the rental property are also tax deductible. These expenses can include fixing plumbing issues, repainting walls, replacing appliances, and more. 5. Home office deduction. Real estate investors who use their home office exclusively for rental property management purposes can deduct a portion of their home office expenses from the taxes. 6. Travel expenses. Real estate investors can deduct travel expenses related to their rental properties. This can include travel expenses to visit the property, meet with tenants or contractors, or attend seminars or conferences related to real estate investing. 7. Professional fees. Professional fees, such as legal and accounting fees, are also tax deductible for real estate investors. 8. Insurance. Insurance premiums paid for the rental property are tax deductible. This includes property insurance, liability insurance, and any other insurance required for the property. 9. Utilities. Expenses related to utilities, such as gas, water, electricity, and trash removal, are also tax deductible for real estate investors. In conclusion, real estate investment tax deductions are an essential tool for investors to reduce the tax liability and increase their net rental income. Investors should keep detailed records of their rental property expenses to ensure that they are claiming all eligible deductions on the tax returns. It is also essential to consult with a tax professional to ensure that all tax laws and regulations are being followed. Real estate investment tax depreciation. Real estate investment tax depreciation is a tax benefit available to real estate investors that allows them to deduct a portion of the cost of the property from the taxable income each year. This deduction is available for the wear and tear that occurs to the property over time as a result of regular use, and it applies to both residential and commercial properties. The IRS allows real estate investors to depreciate the value of the property over a period of 27.5 years for residential properties and 39 years for commercial properties. The depreciation is calculated based on the cost of the property minus the value of the land it sits on, which is not eligible for depreciation. Depreciation is a non-cash expense, meaning that it does not require the investor to spend any money in order to claim the deduction. Instead, it is based on the assumption that the property will lose value over time due to regular wear and tear, and the investor can claim a portion of that lost value as a tax deduction. Real estate investors can use depreciation to lower the taxable income and reduce the amount of taxes they owe each year. This can be especially beneficial for investors who own multiple properties, as the depreciation from one property can offset the income from another property, potentially resulting in a lower overall tax bill. However, it is important for investors to keep in mind that the tax benefits of depreciation are not infinite. When a property is sold, the depreciation that was claimed over the years will be recaptured, meaning that the investor will have to pay taxes on that amount at the time of sale. Additionally, if the property is sold for more than its depreciated value, the investor may owe taxes on the difference. In order to take advantage of the tax benefits of depreciation, real estate investors must keep accurate records of the cost of the property, the value of the land, and any improvements made to the property over time. They should also work with a qualified tax professional to ensure that they are claiming the depreciation deduction correctly and taking advantage of all available tax benefits. Real estate investment tax-exempt status. Real estate investments can provide significant tax benefits to investors, and one of the most important tax benefits of real estate investment is tax-exempt status. Tax-exempt status means that an investment or asset is not subject to certain taxes that would normally be levied on it. There are a few ways in which real estate investments can be tax-exempt. One way is through owning a property that is used for a charitable or religious purpose, such as a church or school. In this case, the property would be exempt from property taxes, as well as certain other taxes. Another way to obtain tax-exempt status for real estate investments is through the use of a 1031 exchange. A 1031 exchange, also known as a like-kind exchange, allows an investor to sell a property and use the proceeds to purchase another property, without having to pay capital gains tax on the sale. As long as the new property is of similar value and uses the old property, the investor can defer paying taxes on the gains until a later date. Real estate investments held in certain types of accounts, such as self-directed IRAs, can also be tax-exempt. With a self-directed IRA, the account holder can invest in a variety of assets, including real estate. The earnings and profits from these investments can grow tax-free until the account holder withdraws the funds, usually after reaching retirement age. It's important to note that while tax-exempt status can provide significant benefits to real estate investors, there are often strict requirements and regulations that must be followed in order to qualify for these exemptions. It's important to consult with a tax professional or financial advisor to fully understand the tax implications of real estate investments and to ensure compliance with all applicable laws and regulations. Real estate investment financing options. Real estate investment is a lucrative venture that requires significant capital investment. Most investors do not have enough cash to buy properties outright, and therefore, require financing options to fund their investments. In this regard, various financing options are available for real estate investors to choose from. This article discusses some of the common financing options available for real estate investment. 1. Conventional mortgages. Conventional mortgages are the most common financing options for real estate investors. These are loans issued by banks, credit unions, and other financial institutions to finance the purchase of a property. The loan terms and interest rates vary depending on the lender and the borrower's creditworthiness. Conventional mortgages require a down payment of between 5% and 20% of the property's value. 2. Hard money loans. Hard money loans are short-term loans that are typically issued by private lenders or investor groups. These loans are ideal for real estate investors who need quick access to capital and cannot secure conventional financing due to the credit history or other factors. Hard money loans are typically issued for a period of 6 to 18 months and have higher interest rates compared to conventional mortgages. 3. Home equity loans. Home equity loans are another financing option available to real estate investors. These loans allow homeowners to borrow against the equity in their homes to finance their investments. Home equity loans have lower interest rates compared to hard money loans and other alternative financing options. However, they are only available to homeowners who have built up equity in their homes. 4. Private money loans. Private money loans are issued by individuals or private lending companies. These loans have shorter terms and higher interest rates compared to conventional mortgages. Private money loans are ideal for real estate investors who cannot secure financing through conventional channels due to the credit history or other factors. 5. Seller financing. Seller financing is a financing option where the property seller agrees to finance the purchase of the property. In this case, the buyer makes a down payment and makes monthly payments to the seller until the loan is paid off. Seller financing is an attractive option for real estate investors who cannot secure conventional financing or do not want to deal with the hassles of dealing with banks or financial institutions. 6. Real estate investment trusts, REITs. Real estate investment trusts, REITs, are companies that own and manage real estate properties. These companies are publicly traded, and investors can buy shares in these companies to invest in real estate. REITs provide an alternative to direct real estate investment, and investors can invest in a diversified portfolio of properties managed by the REIT. 7. Crowdfunding. Real estate crowdfunding is an emerging financing option for real estate investors. In this model, a group of investors pool their resources to fund a real estate investment project. The investors can then share in the profits of the project based on their investment. In conclusion, real estate investment financing options are diverse, and investors need to choose the option that best suits their needs. The choice of financing option will depend on factors such as the investor's credit history, the property's value, and the investor's investment goals. It is important for investors to do the due diligence before choosing a financing option to ensure that they make informed decisions. Real estate investment debt financing. Real estate investment debt financing refers to the use of borrowed funds to purchase real estate assets. Debt financing is a common way for real estate investors to acquire properties, as it allows them to leverage their investments and potentially increase their returns. In this approach, an investor borrows money from a lender, such as a bank or a mortgage company, to buy a property. Debt financing typically involves the use of a mortgage, which is a loan secured by the property being purchased. The mortgage is a legal agreement between the borrower and the lender, which specifies the terms and conditions of the loan, including the interest rate, repayment schedule, and collateral requirements. One of the primary advantages of debt financing is that it allows investors to acquire properties without having to use their own capital. This can be particularly beneficial for new investors who may not have the funds to purchase a property outright. By using debt financing, investors can leverage their investment and potentially generate higher returns, as long as the property's income is sufficient to cover the mortgage payments and other expenses. Another advantage of debt financing is that it can provide investors with tax benefits. The interest paid on a mortgage is tax deductible, which can help reduce the investor's taxable income and increase their after-tax cash flow. However, there are also some risks associated with debt financing. One of the primary risks is the possibility of default. If the investor is unable to make the mortgage payments, the lender may foreclose on the property and seize the collateral. This can result in a significant loss for the investor, as well as damage to the credit score. Another risk of debt financing is the potential for rising interest rates. If interest rates increase, the investor's mortgage payments will also increase, which can negatively impact the cash flow and overall return on investment. In addition, debt financing may limit an investor's flexibility in terms of their investment strategy. If an investor is heavily leveraged, they may have limited options for selling or refinancing the property if market conditions change. Overall, debt financing can be a valuable tool for real estate investors, but it should be approached with caution. Investors should carefully consider the risks and benefits of debt financing and develop a solid plan for managing the debt and ensuring that the property's income is sufficient to cover their expenses and generate a positive return. Real estate investment equity financing. Real estate investment requires a significant amount of capital, which can be obtained through various financing options. Equity financing is one of the options for obtaining capital, where investors raise funds by selling ownership shares in the property to outside investors. In an equity financing arrangement, investors who provide the capital become owners of the property and are entitled to a share of the profits, in proportion to their ownership stake. Equity financing is often used for commercial real estate investments, such as office buildings, retail centers, and apartment complexes. The main advantage of equity financing is that it provides a way to raise capital without incurring debt. This can be particularly beneficial when the property is expected to generate steady cash flows, as it allows the owners to use the profits to pay back investors, rather than using the funds to service debt. Equity financing can also offer a number of other advantages, including 1. Shared risk. When multiple investors are involved, the risk is spread across a larger group of people, reducing the overall risk for any single investor. 2. Flexibility. With equity financing, there is no set repayment schedule, giving investors more flexibility in how they manage their investment. 3. Professional management. In many equity financing arrangements, the property is managed by a professional management company, providing investors with the expertise and resources needed to maximize returns. However, there are also some disadvantages to equity financing, including 1. Dilution of ownership. When new investors are brought in, the ownership stake of the original investors is diluted, reducing their share of the profits. 2. Higher cost. Equity financing can be more expensive than debt financing, as investors expect to receive a higher return to compensate for the increased risk. 3. Potential conflicts. When multiple investors are involved, there is the potential for conflicts to arise regarding how the property is managed and how profits are distributed. Overall, equity financing can be a useful tool for real estate investors who are looking to raise capital without incurring debt. However, it is important to carefully consider the advantages and disadvantages of equity financing, as well as the specific terms of any proposed arrangement, before making a decision. Real estate investment. Seller financing. Seller financing, also known as owner financing, is a type of financing where the seller of a property provides the financing for the buyer instead of a traditional lender. This type of financing can be used for both residential and commercial real estate investments. In seller financing, the seller and buyer negotiate the terms of the loan, including the interest rate, down payment, and repayment period. The buyer then makes payments directly to the seller until the loan is fully repaid. The seller retains the deed to the property until the loan is paid off. One advantage of seller financing is that it can be easier to qualify for than traditional bank loans. The seller may be more flexible in terms of credit score, income verification, and other factors that traditional lenders typically consider when underwriting a loan. Another advantage of seller financing is that it can be quicker to obtain. The buyer and seller can negotiate the terms of the loan directly, without having to go through a lengthy loan application process with a bank or other lender. This can be especially useful in situations where the property is unique or unconventional, and traditional lenders are reluctant to provide financing. Seller financing can also benefit the seller. By providing financing, the seller can often sell the property more quickly, and at a higher price than if they were to require a traditional bank loan. Additionally, the seller can earn interest on the loan, which can be a source of passive income. However, seller financing also has its risks. The seller is essentially acting as the lender, and therefore assumes the risk of default. If the buyer is unable to make payments, the seller may be forced to foreclose on the property to recoup their investment. Additionally, the seller may have to deal with the costs and complexities of foreclosing on a property, which can be time-consuming and expensive. In summary, seller financing can be a useful tool for both buyers and sellers of real estate. It can provide an alternative to traditional bank financing, and can be easier and quicker to obtain. However, it also carries risks, and both parties should carefully consider the terms of the loan and the potential consequences of default before entering into a seller financing agreement. Real estate investment. Hard money lending. Real estate investment can be an attractive opportunity to generate a high return on investment, but finding the necessary capital to fund such investments can be challenging. This is where hard money lending comes in as a financing option for real estate investors. Hard money lending is a type of short-term, asset-based loan that is typically used to finance real estate investments. The loan is secured by the value of the property, rather than the borrower's credit score or financial history. This makes it a popular option for real estate investors who may have a poor credit history or limited financing options. Hard money loans are typically provided by private investors or investment firms who specialize in real estate lending. They can be used to finance a variety of real estate investment opportunities, including fix and flip properties, rental properties, and commercial real estate. Hard money loans are generally short-term loans, ranging from a few months to a few years, and typically have higher interest rates and fees than traditional bank loans. One of the advantages of hard money lending is the speed at which a loan can be approved and funded. Unlike traditional bank loans, which can take weeks or even months to process, hard money loans can be approved and funded within a matter of days. This can be particularly beneficial for real estate investors who need to move quickly on a potential investment opportunity. Another advantage of hard money lending is the flexibility of the loan terms. Since the loan is secured by the value of the property, rather than the borrower's credit score or financial history, the lender is often more willing to negotiate the terms of the loan. This can include a lower down payment, a longer repayment period, or a more lenient repayment schedule. However, hard money lending also has some drawbacks that real estate investors should be aware of. The higher interest rates and fees associated with hard money loans can significantly increase the cost of the investment. In addition, hard money loans are generally short-term loans, which can be a disadvantage if the real estate investor is unable to repay the loan within the specified timeframe. Overall, hard money lending can be a valuable financing option for real estate investors who need to move quickly on an investment opportunity or have limited financing options. However, it is important for investors to carefully consider the terms of the loan and the potential costs associated with the loan before making a decision. Real estate investment. Private lending. Private lending in real estate investment is a form of debt financing in which an individual or group of individuals provide loans to borrowers who may not qualify for traditional financing. Private lending is a common way for real estate investors to obtain financing for the projects, particularly when they need to act quickly or when they don't qualify for a traditional loan due to factors such as credit score, income, or property condition. Private lending can take many forms, including loans secured by a mortgage, trust deed, or other collateral. Private lenders may also require a personal guarantee or other types of collateral to mitigate their risk. One advantage of private lending is that it can be a relatively fast and flexible option for real estate investors. Because private lenders are typically individuals or small groups, they may be able to make a loan decision quickly and with less bureaucracy than a traditional lender. Additionally, private lenders may be willing to work with borrowers who have more complex financing needs or who are purchasing a property that doesn't meet the strict guidelines of traditional lenders. However, private lending can also come with higher interest rates and fees compared to traditional financing. This is because private lenders are taking on more risk by lending to borrowers who may not qualify for traditional financing. As a result, borrowers should carefully consider the costs associated with private lending before entering into an agreement. To find private lenders, real estate investors can network with other professionals in the industry, such as real estate agents, attorneys, and mortgage brokers. Investors can also search for private lending companies and individuals online, although it's important to thoroughly vet potential lenders to ensure they are reputable and have experience in real estate lending. Overall, private lending can be a valuable tool for real estate investors looking to obtain financing for the projects. However, it's important for investors to carefully consider the costs and risks associated with private lending and to work with experienced and reputable lenders. Real estate investment. Mortgage lending. Real estate investment often requires financing, and one of the most common ways to finance a real estate investment is through a mortgage loan. A mortgage loan is a type of loan that is secured by real estate, meaning that the property being purchased with the loan serves as collateral. The borrower agrees to pay back the loan, plus interest, over a period of time, usually ranging from 10 to 30 years. Mortgage lending involves a few key players: the borrower, the lender, and the mortgage broker. The borrower is the person or entity seeking to purchase the property and is responsible for repaying the loan. The lender is the financial institution providing the loan, such as a bank or credit union. The mortgage broker is the intermediary between the borrower and the lender, helping the borrower find a suitable lender and negotiating the terms of the loan. There are two main types of mortgage loans: fixed rate and adjustable rate. A fixed rate mortgage has a set interest rate for the life of the loan, meaning that the borrower's monthly payment will remain the same throughout the term of the loan. An adjustable rate mortgage (ARM) has an interest rate that can change over time, meaning that the borrower's monthly payment may fluctuate. Mortgage loans also come with different terms and conditions, such as the loan-to-value ratio (LTV), which is the amount of the loan compared to the value of the property being purchased. A higher LTV means the borrower is borrowing a larger amount of money compared to the value of the property, which can result in a higher interest rate and more stringent lending requirements. In addition to traditional mortgage lending, there are other types of mortgage loans that cater to specific types of borrowers, such as government-backed loans like FHA and VA loans, which have lower down payment requirements and more flexible lending requirements for qualified borrowers. There are also private mortgage lenders that specialize in providing loans to borrowers who may not qualify for traditional mortgage loans, but who have other assets to offer as collateral. Mortgage lending is an essential component of real estate investment, and understanding the different types of loans and lending options available is crucial for making informed investment decisions. It is important to consider factors such as interest rates, loan terms, and repayment options when selecting a mortgage lender and choosing a loan that fits your investment goals and financial situation. Real estate investment mezzanine financing. Mezzanine financing is a type of real estate investment financing that combines debt and equity financing. It is typically used when the borrower needs more funding than they can get from traditional debt financing, but does not want to give up too much equity. Mezzanine financing is a type of subordinated debt, meaning that it has a lower priority than senior debt in case of default or bankruptcy. In real estate investing, mezzanine financing is often used to finance the acquisition or development of commercial properties, such as office buildings, shopping centers, or hotels. It can also be used for refinancing existing debt or for financing the expansion of an existing property. Mezzanine financing usually has higher interest rates than traditional debt financing, as it carries more risk. However, it is often more flexible than traditional debt financing, as it may have fewer restrictions and covenants. Mezzanine financing can also provide a higher return on investment for the lender, as it may include an equity component in the form of warrants or equity participation rights. To obtain mezzanine financing, the borrower typically needs to have a strong track record in real estate investing, a solid business plan, and a clear exit strategy. The lender will also conduct due diligence on the property and the borrower's financial situation to assess the risk involved in the investment. Overall, mezzanine financing can be a useful tool for real estate investors who need additional funding but do not want to dilute their equity too much. However, it is important to carefully evaluate the terms and risks of mezzanine financing before entering into an agreement. Real estate investment bridge financing. Real estate investment bridge financing refers to a short-term loan that provides funding for an individual or organization to acquire a property, while they secure a longer-term financing option, typically within 1 to 3 years. The term bridge, in this context, refers to the temporary support given to the borrower while they make the transition from one financial situation to another. Bridge financing is a useful tool for investors who need quick access to capital to purchase a property, but may not yet have the necessary collateral or credit history to qualify for a long-term loan. Bridge financing is often used by real estate investors who want to take advantage of a unique investment opportunity or a time-sensitive deal. It can also be used by property owners who need to complete renovations or make other improvements to the property in order to increase its value and make it more attractive to traditional lenders. The terms of bridge financing are typically more flexible than traditional mortgage loans, which allows for a faster and smoother application process. This can be especially beneficial for investors who want to move quickly on a property that is in high demand. Additionally, bridge financing can be secured by a wider range of assets than traditional loans, such as the equity in a property or even future revenue from the property. However, bridge financing typically comes with higher interest rates and fees than traditional loans, as the lender is taking on a higher degree of risk by providing financing without the same level of collateral or credit history as long-term loans. Therefore, it is important for investors to carefully evaluate the costs and benefits of bridge financing before deciding whether it is the right option for the specific investment goals and financial situation. Overall, bridge financing can be a valuable tool for real estate investors who need short-term capital to acquire a property or complete renovations while they secure a longer-term financing option. However, investors should carefully evaluate the costs and benefits of this type of financing and work with an experienced lender to ensure they are making a wise investment decision. Real estate investment joint venture financing. Real estate investment joint venture financing is a partnership between two or more parties to finance a real estate investment. The parties involved can be individuals, businesses, or organizations that pool their resources together to fund a real estate project. Joint venture financing is a popular option for real estate investors who want to combine their resources to take on larger, more lucrative real estate projects that would be beyond their individual financial capabilities. There are two types of joint ventures in real estate investing: the equity joint venture and the debt joint venture. 1. Equity joint venture. In an equity joint venture, two or more parties contribute capital to fund the real estate project. The parties involved share the profits and losses of the investment in proportion to their investment. For example, if two parties invest $500,000 and $1 million respectively in a real estate project with a total investment of $2 million, the profits and losses will be shared in the ratio of 1:2. Equity joint ventures are common in commercial real estate development, where investors pool their resources to acquire land, build and develop commercial properties such as office buildings, shopping malls, and industrial parks. 2. Debt joint venture. In a debt joint venture, one party provides the capital to fund the project while the other party provides the collateral or security for the loan. The borrower is responsible for repaying the loan with interest, and the lender receives a fixed return on the investment. Debt joint ventures are common in real estate investing where one party has the capital to fund the project but lacks the collateral required to secure a loan. In such a case, a joint venture partner can provide the collateral in exchange for a share of the profits. Joint ventures have many benefits for real estate investors, including 1. Access to more capital. Joint ventures provide access to more capital than individual investors could generate on their own. This allows investors to take on larger real estate projects with the potential for greater returns. 2. Risk sharing. Joint ventures allow investors to share the risks and rewards of real estate investing. This reduces the risk of financial loss and increases the potential for profits. 3. Diversification. Joint ventures allow investors to diversify their real estate investments by investing in multiple projects with different risks and returns. 4. Access to expertise. Joint ventures allow investors to tap into the expertise of the partners, who may have experience in real estate development, property management, or finance. However, joint ventures also come with some drawbacks, including 1. Potential conflicts. Joint ventures can lead to conflicts between partners due to differences in investment goals, management styles, and risk tolerance. 2. Loss of control. Joint ventures require investors to share control of the investment, which can lead to disagreements over management decisions. 3. Complex structures. Joint ventures can be complex, with many legal and financial considerations that must be carefully negotiated and documented. Overall, joint venture financing is a powerful tool for real estate investors looking to expand their investment opportunities and increase the potential returns. However, investors should carefully consider the risks and rewards of joint venture financing before entering into any partnership. Real estate investment refinancing. Real estate investors often use refinancing to lower their interest rates, access equity, or secure better loan terms. Refinancing is the process of obtaining a new loan to pay off an existing mortgage or other debt secured by a property. This new loan typically has different terms than the original loan, such as a different interest rate, payment amount, or maturity date. There are various reasons why an investor may consider refinancing their real estate investment, including 1. Lower interest rates. Interest rates may have decreased since the initial mortgage was taken out, which could result in a lower monthly payment and/or total interest paid over the life of the loan. 2. Access to equity. An investor may have built up equity in the property since the original mortgage was obtained, which can be accessed through a cash-out refinance. This allows the investor to take out a new loan for more than the amount owed on the original mortgage and receive the difference in cash. 3. Better loan terms. An investor may want to change the terms of their mortgage, such as the length of the loan or the type of interest rate, e.g., from an adjustable rate to a fixed rate loan. 4. Consolidating debt. An investor may have multiple loans on different properties or lines of credit that they want to consolidate into one loan. When refinancing a real estate investment, there are several factors that investors should consider, such as 1. Closing costs. Just like when obtaining a mortgage, refinancing a property comes with closing costs, which can include appraisal fees, loan origination fees, title fees, and other costs. These costs can range from 2% to 5% of the loan amount and should be factored into the decision to refinance. 2. Loan-to-value ratio. The loan-to-value (LTV) ratio is the amount of the loan compared to the value of the property. Lenders typically have maximum LTV ratios that they will lend against, and investors may need to provide a larger down payment or obtain private mortgage insurance (PMI) if their LTV ratio is too high. 3. Credit score. Refinancing, like obtaining a mortgage, is based on an investor's creditworthiness. A higher credit score can lead to better loan terms, while a lower credit score may make it more difficult to obtain a loan or result in higher interest rates. 4. Cash flow. Refinancing can affect the cash flow of a property, as the new loan may have a longer or shorter maturity date, a different interest rate, or a higher monthly payment. Investors should consider how refinancing will impact their overall cash flow and profitability. 5. Exit strategy. Investors should also consider their exit strategy for the property, as refinancing can impact the ability to sell the property in the future. For example, refinancing with a cash-out refinance can reduce the amount of equity in the property, which may make it more difficult to sell in the future. Overall, refinancing can be a useful tool for real estate investors to improve the cash flow, access equity, and secure better loan terms. However, investors should carefully consider the costs, benefits, and potential risks before deciding to refinance their investment property. Real estate investment property flipping. Real estate property flipping is the act of purchasing a property, renovating it, and then quickly reselling it for a profit. This investment strategy has become popular in recent years, thanks in part to TV shows that showcase the practice. Property flipping can be a profitable investment, but it also comes with risks. One of the most significant risks of property flipping is that the market could shift before the investor is able to sell the property. This could result in the property being sold for less than the investor paid for it or even a loss. Additionally, unforeseen renovation costs could eat into the profits, reducing the overall return on investment. To mitigate these risks, property flippers need to conduct thorough research on the market and the property itself. This includes assessing the property's current condition, researching the neighborhood's market trends, and estimating the cost of renovations. Once the property is purchased, it's important to carefully manage the renovation process to ensure costs stay within budget. This involves working with contractors, selecting materials, and overseeing the project's progress. Time is also a critical factor, since the longer it takes to complete the renovation, the more carrying costs the investor will incur. After the renovation is complete, the investor needs to price the property strategically to maximize profits. This involves researching the local real estate market and setting a price that is both competitive and reflective of the property's value. Property flipping can be a lucrative investment strategy, but it requires careful planning, execution, and attention to detail. Successful property flippers often have a team of experts, including real estate agents, contractors, and accountants, to help them navigate the process and maximize profits. Real estate investment. Passive investing. Passive investing in real estate refers to a type of investment where an investor puts their money into real estate projects or properties with the intention of receiving a return on investment without actively managing the investment themselves. This type of investment is often attractive to those who are looking to diversify the portfolio and earn passive income without the time commitment of actively managing properties. One of the most popular ways to passively invest in real estate is through real estate investment trusts, REITs. A REIT is a company that owns, operates, or finances income-generating real estate, and allows investors to buy shares in the company. REITs are required by law to pay out at least 90% of the taxable income to shareholders in the form of dividends, making them a popular option for those seeking regular income. REITs also offer the benefits of liquidity, diversification, and professional management. Another option for passive real estate investment is through crowdfunding platforms, which allow investors to pool their money together to invest in a variety of real estate projects. Crowdfunding platforms typically offer a wide range of investment opportunities, ranging from residential and commercial properties to development projects and even real estate debt. Real estate limited partnerships, RELPs, are another form of passive real estate investment. A RELP is a partnership between an investor and a general partner who is responsible for managing the investment. The general partner typically receives a share of the profits and has control over the management of the investment, while the limited partners provide the funding and receive a share of the profits. Real estate index funds are another option for passive real estate investment. These funds are designed to track the performance of real estate indices, providing investors with exposure to the real estate market without the need for active management. Index funds can be a low-cost and low-risk way to invest in real estate, but they offer less control over the specific properties or projects that the investor is investing in. Overall, passive investing in real estate can be an attractive option for those looking for a hands-off approach to investing, but it's important to carefully research and understand the specific investment vehicle and the risks involved before investing. It's also important to consider factors such as fees, liquidity, and diversification when choosing a passive real estate investment strategy. Real estate investment. Active investing. Real estate investment is a broad term that encompasses various investment strategies, one of which is active investing. Active investing involves taking a more hands-on approach to investing in real estate by actively managing the investment property or properties to generate income and maximize profits. Active real estate investing can take many forms, from buying and holding rental properties to fix and flip deals, development projects, and more. The goal of active investing is to add value to the property or properties, generate cash flow, and sell for a profit. One common active investing strategy is buying and holding rental properties. This involves purchasing a property and renting it out to tenants, collecting rent payments, and managing the property to ensure it remains in good condition. Investors who choose this strategy typically aim to generate long-term passive income and build equity in the property over time. They may also use leverage to purchase additional properties and grow their rental portfolio. Another active investing strategy is fix and flip, which involves purchasing distressed properties, making repairs and renovations, and then selling the property for a profit. This strategy requires a good understanding of the local real estate market and the ability to identify properties with potential for value-add improvements. Investors who choose this strategy must also have the ability to manage contractors, budget for repairs, and market the property effectively to attract buyers. Development projects are another example of active investing. This strategy involves purchasing land or a property with the intent of developing it into a new project, such as a residential or commercial building. This strategy requires a significant amount of capital and a high level of expertise in real estate development. Investors must be able to navigate zoning regulations, secure financing, and manage the construction process to ensure the project is completed on time and within budget. Active real estate investors may also consider other strategies such as investing in real estate investment trusts, REITs, participating in syndications, or investing in private equity funds that focus on real estate. These strategies typically require a higher level of capital and may involve more complex legal structures. In summary, active real estate investing involves taking a more hands-on approach to investing in real estate to generate income and maximize profits. This strategy requires a good understanding of the local real estate market, access to capital, and the ability to manage properties and projects effectively. Investors who choose this strategy may pursue various investment strategies such as rental properties, fix and flip deals, development projects, and more.